going to be talking about is just a little bit of stuff about order flow, and I'll just take a quick screenshot, guys, so that I can show you some pretty simple stuff here. This is gold that we're going to be looking at, but it's irrelevant what the market is. It's just the order flow that we're going to be paying attention to, and it's something that you probably subconsciously already pay attention to, because it's the concept of exhaustions. But what we're trying to do with this classroom, guys, is we're trying to take you away from indicators, and we're trying to get you reading the tape. We're trying to get you to read this candle here and figure out whether there's exhaustion in it. We're trying to get you to read this candle without having an indicator, because an indicator has serious drawbacks. And when you stop a second and think about it, you must agree with me, an indicator has serious drawbacks. Why is that the case? Because for you to have an indicator that defines what exhaustion is, you've got to define certain parameters. So in other words, you could define the concept of if it goes from 0 to 10 lots, that's not exhaustion. If it goes from 0 to 25 lots, that is exhaustion. Well, you're the one that has to determine that, but obviously there's a line in the sand, say 25 lots. So if it comes in at 24 lots, it's not exhaustion, but if it comes in at 25 lots, it is exhaustion. What the hell's the difference? You know what I mean? But for the purposes of programming, you've got to draw a line. You've got to draw a line somewhere. So when you're looking at a chart, one of the things you're always looking at, and as I said, this is gold. It's a straight line rally we've seen on gold there. It was beautiful. A little quick profit on that for about $250. But the point is, there's so much information on these order flow charts that you're going to start being able to look at it and go, I kind of get that. And it's called the book ratios. So what the hell are the book ratios? Anybody know what the book ratios are? Something that the pit guys would basically do mentally in their own head. Anybody know what the book ratios are? Okay, so very easy to see what the book ratios are on any particular chart. So what we'll do is we'll create a couple of scrub that. We'll take it down a little bit. We'll create a couple of selling candles. And a couple of buying candles so that we can look at exhaustions and stopping volume concepts. Okay, so the two red candles, what we're actually paying attention to in a red candle isn't necessarily the selling, it's the buying. Because obviously in a red candle, if I was to draw a number here, obviously what we're going to do is the right-hand side of the book is the offer and the left-hand side of the line is going to be the bid, so that you get a basic idea that this is on the right-hand side of the line, yeah? Pretty basic stuff. But if I was to draw a number here, 40 and 10, it's a down candle. 40 and 10, it's a down candle. So what is that in terms of the book ratio? Well, you divide 10 by 40. You divide 10 by 40, so what's the book ratio? And many order flow softwares have this. Market Delta has it. Noft, I think, has it. OFA might have it. I'm not sure, but you know, a lot of the softwares have it. But I'm not interested in the software. I'm interested in the triggers. The ratio is 0.25, isn't it? The ratio of the top price to the bottom price, well, not the bottom price, the next price is 0.25. Well, what would you say that is? Is that exhaustion or is that stopping volume? What would you say it is before I actually type out what it is? Would you say that's exhaustion or stopping volume? All the guys that know about sequential declines will know exactly the answer to this question. It's stopping volume. Now, anybody that, as I said, that uses OrderFlow software will know this, because anybody that's seen an exhaustion print will know exactly what an exhaustion looks like. An exhaustion print will look like this: 10, 40, 60. The price going up into the top edge, basically getting less and less and less and less. And that's an exhaustion print, isn't it? Does everybody understand that? Because this is the buy side of the book, remember. So if the buy side of the book was 10 and then upticked into 40 and it stopped and then downticked, it must be stopping volume. If the price upticks from 60 to 40 to 10, it's just exhausting, isn't it? The buyers are exhausting out. So think about the supply and demand line. Think about your market profile in terms of just buyers and sellers. Think about it. So if I was to do what is this? So this is exhaustion. This is exhaustion here. So if I was to draw the supply and demand out on this chart, then what would it look like? Well, I'll just draw the profile, won't I? I'll just draw the profile. So obviously the price is the profile here. Let's just assume we're starting in the middle here. That's what that profile looks like, doesn't it? So for that to stop with that volume, it's got to be stopping volume. And it did stop at that volume because it's a red candle. This is exhaustion, and if you were to look at a profile for this exhaustion, it might be something like this. Agreed? Because the volume is increasing on the downtick and decreasing on the uptick. So you can obviously see quite clearly that that's moving into what you would call a seller's auction, isn't it? Does everybody agree with that? Now this might not be it's only stopping volume temporarily. It might not stop the market dead, but it's stopping volume. What's the ratio on that exhaustion candle? The ratio on this one, 0.25, and that's stopping volume. What's the ratio on this exhaustion candle here? I don't think it was that difficult a question. Tim said a go at it. 4.0. So the book ratio is 4.0 in this candle, isn't it? The book ratio, 4.0. Now, why is this interesting? Why is this important? Because one of the things that you're going to be always watching, and as I said, this is something that the floor guys are just jotting on the back of their order tickets, is they're watching to see, for example, somebody comes in here with 40 buys. Somebody comes into the market and flashes up 40, and it gets bought. So let's assume Goldman's comes in and flashes up 40 long. Somebody takes the 40, and immediately they take the 40, the price drops. Well, that's got to be useful information. If somebody takes the 40 and the price drops, well, number one, there's a trapped buyer at that higher price. There's a trapped buyer at this higher price. Number two, there's an absorption of that buying anyway. So there's going to be, so we know that there's a big boy that's holding the price, because normally it just exhausts out, doesn't it? Normally it just exhausts on the downtick. So there's a big boy holding this price tight and taking the market offered. Now, obviously, if it just comes off that 40 and it goes 40, 10, 5, 1, and then starts rotating back off the 1 back up towards the 40, there's a very good chance that we're going to pop the 40, isn't it? Very good chance. But obviously, we've drawn the candle in, so that's not what happened. It's not what happened. So let's do the opposite side. Buy candles. Would it be any surprise that the buy candle is obviously going to be focused on the sellers? Not really. You want to know what the sellers are doing. In a buy candle, you should always be aware of the fact that there's obviously buyers at low prices and they're going to distribute at higher prices, but I want to therefore focus on what the sellers are doing on a buy candle. So therefore, we're going to be focused on this bottom left-hand section of the chart, this bottom left-hand section of the footprint or the candle. So if I went and did just simply do the opposite, if I went exact opposite, guys, 10 and 40. Can you see what this is, 10 and 40? Would you agree with me that this is pretty obvious? Stopping volume at the bottom, isn't it? Stopping volume. That's got to be stopping volume because it's stopped, that big volume there has stopped the price. So this is stopping volume. And obviously the ratio in that stopping volume is 0.25, isn't it? If it was 10 to 50, say there was 50 sellers, then it'd be 0.2. If it was 10 to 100 sellers, it'd be 0.1. So the closer we get to zero, you see what I'm saying? So if I did 10 lots on the price above and 100 lots on the price below, the ratio would be 0.1. So obviously the closer you get to zero, the bigger the stopping volume, yeah? The closer you get to zero, the bigger the stopping volume. Okay? So if we got down to 0.01 or 0.05 or something like that, that's a lot of stopping volume against the price action, isn't it? And likewise, if we get this candle here and it goes one lot, $50 lots, that's obviously exhaustion, isn't it? Because you just had a 50 lot seller dropping down to a single. Where the hell did the rest of the sellers disappear? So that's a lot of exhaustion. And obviously that exhaustion ratio is what? That exhaustion ratio must be 50. So obviously, the smaller the number here, the bigger the stopping volume. The bigger the number here, the bigger the exhaustion. Sorry, Ian, there's a couple of questions. Is the book ratio just calculated from the first two levels? Yep, from just these two. But here's the point, Ian. So it's calculated against the ratio is calculated against these levels here. That's what most software would provide you with, is that ratio. But you can look at this everywhere on every single candle. You can look at it inside the middle of a candle to see the next phase of stopping volumes and exhaustion prints inside the candle. So the calculation in terms of software is the top two prices in a red candle here, or the bottom two prices in the green candle here. But when you're actually reading the tape properly, the whole candle is available for an interpretation of some sort. So which of these two, what is better in terms of a support line or a resistance line out of these two particular trades, stopping volume or exhaustion? What is better as a support line or a resistance line? Which of these two trades is better from a point of view of a resistance or support line? Stop traders. Stop traders. Absolutely stop traders. Why? The reason why is that idea that there is trap traders in here. So, for example, the price breaks away to the downside. We don't know if those 40 buyers manage to get off the trade, but what you can guarantee is that there's a very good chance that if the price trades back to this level, that they will get back off the trade because they've just got a get out of jail card. So the chances are that this price will obviously then act as quite a serious level of support. So we understand that by identifying stopping volume relationships, heavy stopping volume relationships, 0.1 for example, the bigger this stopping volume relationship, the bigger the trap basically that's coming into the marketplace. So if we understand that, if we kind of accept that this is a pretty simple basic read of tape reading, if this is a very, very simple basic understanding of tape reading, and we go back to this chart here, which is gold, then obviously it's all green bars. So the good news is you don't have an awful lot to interpret, do you? You don't have a huge amount to interpret. So if you've got a little calculator in front of you, I want you to think about whether you've got stopping volume on all of these candles or whether you've got exhaustion on all of these candles. Now, it's really easy to think about because obviously if the candle is, for example, this one, what's the ratio on this one here, guys? And I'm talking about this little candle. To get you started, what's the ratio on this one where the cursor's flashing? Yep, the ratio is 16. The ratio is 16 because you're looking at how much selling pressure is coming in. And therefore the ratio is 16. Is that stopping volume or exhaustion? Yeah, that's exhaustion. So that's not going to be a particularly great support level, is it? It's just simply there's been no sellers at that price. We don't know if there was any buyers at that price. And surely a support level has buyers at that price. Well, we don't know that they might be there, but we don't know that they're there. See what I mean? Let's go along to the previous candle here, the previous candle. 58 divided by 23. 58 divided by 23. Obviously, it's 2.5 approximately. And that's just exhaustion as well, isn't it? It's got to be just exhaustion. There's no way other way of reading that. That's just an exhaustion sell print. This one is 20. That's an exhaustion sell print, yeah? But take a look at this one. What do you see on this candle here, the first candle? What do you see in the first candle? Candle number 1. Stopping volume. Stopping volume. 0.4, isn't it? 0.4. So is that a support level or resistance? What is this? Is it exhaustion, support, resistance? What is it? What does it mean? 0.4. What does that mean? If you're sitting on if you're in the pit, the trading pit, and suddenly you see that there's a price that's got a level of 0.4 attached to it, it's not the biggest, or in that respect, the lowest number, is it? But it's still some sort of support, isn't it? So we can identify that this is actually a support level here. Well, if that's a support level, and the price trades down into this area and exhausts, is that not a really good piece of information? If you see that exhaustion print coming in here, would it not be reasonable for you to then buy perhaps on the uptick away from that volume above you? Would that not be a reasonable trade with a 3-tick stop? I'd think it would be. Yeah, I would think it would be. If I now have two pieces of clear information, stopping volume, support line, exhaustion print, and then trading above the volume node, that's a very, very good opportunity to maybe pick up some long gold off of that price right here, isn't it? Very good opportunity to pick up some long gold. You could put a buy stop order in there when this volume is building. You get taken into the trade, and bob's your ante. Perfect. So let's carry this analysis on a little bit. Let's carry this analysis through the remaining green bars. What's the next candle? Is it exhaustion, or what are we talking about here? Hopefully you can make out the numbers. What are we talking about this candle? Exhaustion, isn't it? It's exhaustion 2.6. 2.6, and that's an exhaustion print. So that's good news as well, because it ultimately means that there's still exhaustion on downticks. 51 by 30. 51 by 30. Not the strongest, but it's certainly below 1, and therefore should up in volume. And that therefore becomes a possible support location, doesn't it? That becomes a possible support location. Now, interestingly enough, what happens on the next one? $0.2. Stop. Stop. Well, that's just added to the quality of that level, hasn't it? It's just added to the quality of this level by putting another bit of stopping volume in here. And you're thinking to yourself, that's interesting. That's good. That's pretty good. That's perhaps a level that I should be paying attention to in the future. You can obviously look at it. You can see it. You can mark it on your charts. And you don't have to do squat diddly if the price gets back to it. You don't have to do squat diddly as the price if the price gets back to it. But obviously, if you can be aware that that's stopping volume, and you can mark that stopping volume in the charts, I'll actually just bring across the gold chart for you because it's actually just around about 20 past 4 when that stopping volume came in. Here it is here. There's the 51 by 30 and the 17 by 5 area there, see it? So this is your stopping volume area right here. Do you see that? Everybody agree that I've not done anything different from what we've just talked about. We've just put a stopping volume on the charts. So if that's the stopping volume, then obviously we should be very, very mindful of any price trading into this kind of area here. Agreed? We should be mindful of any price trading into this area here. We should be mindful of anything trading down into this area here. Well, guess what happens? The price trades down into this area within one tick of it. And we're getting exhaustion prints. Is that a good possible buy trade on that exhaustion there, guys? Good possible buy trade? You'd think so. Because if it's exhausting into a level that we've already marked on the charts, is that a good place to maybe launch an attack on the buy side? Well, if you took the trade, it went 1, 2, 3, 4, 5, 6. It went $70 to the upside, $70 to the upside, and then we could see on the uptick, for example, here it started to ice up and you could simply have came off with a $50 profit. It only took you 2 or 3 minutes. Literally only took you more than that. 1, 2, 3, 4, 5, 6, 7 minutes. Took you 7 minutes, guys, to get up into that level. But take a look. Take a look. I'm just continuing this line out. That's all I'm doing. I'm not doing anything special. I'm not doing anything that you couldn't see for yourself on the charts, but take a look. The price comes back into the level. What do we get here? I know it's on a red candle, but we get stopping volume here, don't we? And if the price then ticks away from that, we get stopping volume in this candle as well. So we've got stopping volume on these two candles here at exactly the same price that we had a support line. What happens next? The price goes off by 1, 2, 3, 4, 5, 6, 7, $80. $80 more, guys. Price trades back down to this supporting level again here. What happens? We've now got this new level for support zones because this was stopping volume. This was stopping volume. This provides a support. Price trades in, exhausts into this area. What happens next? The price goes 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, $120 in 4 minutes. $120 in 4 minutes. That's 3 trades you've had off of that support, not including the earlier trade that we had on this screen, not including the bottom edge print that we had on this screen where we got that stopping volume right there. Look, it doesn't include that trade where we got the first buy trade, which was at a price of $12.50, right off a wholesale, isn't it? Right off the wholesale price. Surprised that you got a wholesale buyer coming in at $1,250 on gold? And a few people are saying, bloody hell, I wish I was trading gold today to trade off a big level like $12.50. That's just a little bit sensational, if you ask me. Yeah, of course it is, because that's going to have a lot of hedgers below $12.50, isn't it? It's one of the big key levels on gold. So, of course, if you see stopping volume coming into $12.50, it's going to be an enormous opportunity for you to pick up some business at that level, isn't it? And then subsequent to that, if I just zoom out a little bit and drag the chart across a little bit so you can see basically what happened to that trade. Take a look. Take a look at how amazing that trade turned out to be in terms of those stopping volume areas. Look. You see it? I mean, it's not a big trade. It's not one of the trades that's going to make you $1 billion in 5 minutes, guys. But this is from 16:15 to 17:10. It's about an hour's worth of business on a gold market that's only went $3, $3. That's all it's went. And you would have had a buy trade here. You'd have had a buy trade in here, 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 and you never had a single trade go against you by more than 1 tick. 1, 2, 3, 4, 5 trades, and it didn't go against you by more than 1 tick on 5 occasions. So you could have easily have got away with a 3 tick, 4 tick, 5 tick stop on gold, and you've obviously just made yourself perhaps $300 on that one, 150, 450, 500, 550, 600, $600 in the last hour on a single contract with a $30 stop. That's pretty good trading, is it not? What do you think? Pretty good trading? I would say that's absolutely spot on perfect. And yet it comes down to a very simple order flow concept of what the pick guys do. It comes down to this very simple order flow concept of what the pick guys are watching. Buy orders and sell orders. They're always reading the buy orders or sell orders every time the price comes through the book. So they can see that there's 71, the volume's actually picking up here, so you can see that there's a volume element to this. But you can see it's also an exhaustion print, isn't it? It's an exhaustion print, it's 2 point something, isn't it? 17 against 175, it's 2 point something, and that's an exhaustion. So we don't have to worry about that trade. We don't have to think anything particularly about it. This trade here is 3, is also an exhaustion print. We're not seeing any real selling pressure coming in. This is an interesting one because it's 1.0. Difficult to know exactly what that is because it's at 1.0. It's not exhaustion and it's certainly not stopping volume. This one is at 77. That's a pretty easy read. That's exhaustion. This one is at 5. What is that? Well, that's exhaustion. None of these are going to provide you with support levels because we don't know if there's selling coming in here at the bottom tick price. We don't know that. What about this one? It's still exactly the same. It's 1 point something, isn't it? Which is still exhaustion. Now, what I said earlier is and it was in response to a question that Ian made, was that is it the 2 bottom ratios? And the answer is yes, it is. According to the software, it's always the 2 bottom ratios that you're paying attention to, because that's where we want to make sure that we're getting the correct read. Make sure that you understand that there is either stopping volume or exhaustion on the down ticker, and then obviously watching what happens towards the top edges of each of these trades. But you can see that if we just watched for the stopping volumes, which happened obviously over here, and here, And here, we can use those levels for support because we've already identified that stopping volume is support levels. Exhaustion is not a support level. Well, if you were just a price action trader, would you know the difference? If I said to you, I'm going to put a chart up for you. I'm going to put a chart up for you very quickly. Okay? And I'm going to say to you, is that a support? Is that a support level? Well, according to price action, yeah, it's a support level. Yeah, brilliant. It's a support level, big institutional buying. Remember what I used to keep talking about before when people were talking this rubbish about a big institutional buyer must have came in. If I now populate that big institutional buyer, and that's the numbers going into that, is that a big institutional buyer that's just stepped in? So if I was to then draw a line of exhaustion along, if I was to draw a line of support along here, what's the chances that the price is just going to go and take a rip right through this level? Well, because there's no real actual buyers there. We haven't identified a level where there's any buyers. You understand the difference? So if you were looking at a candlestick pattern, you can't just draw a line off of a pin rejection candle, can you? Doesn't make any sense to draw a line off of a pin rejection candle because it's just a pin reject. You don't know if it's exhaustion. You don't know if there's buyers there or sellers there. You've got no way of knowing that unless you actually look at the order flow that's inside that candle. But if I change that order flow, and I said that there was 120, 100, is that a level that you want to know about with that candle? Is that a level you want to know about with that candle now? The answer is, oh God, aye, absolutely. That 100 lots at the bottom edge, yeah, absolutely. Damn tootin'. So when the price trades back into this level, we're going to be watching for it because we're now expecting to see that buyer who took on that 100 lot seller taking them on again. Because that guy that sold 100, you can bet at your bottom dollar that if he's not out the trade already, he's going to take this retest as a great opportunity to buy his 100 lot back for scratch. And why the hell shouldn't he? Why the hell shouldn't he? We've just about to take a squeeze on in the oil, the gold here. Just about to try and get the squeeze on, guys. Let's see if it's successful. Paycheck level at the top. We've just had the before she goes squeeze. It's tight at the top here. It's really tight at the top. But let's see if we get the before she goes squeeze. We'll come back to that chart in due course. But this is the point we're trying to make. If I can now establish that this is a good level to maybe deal with, well, you've just seen how to do it in terms of how the old pit traders would have done it. They just basically do the book ratios. They're just watching the ratios in the book, but they're not looking at candles. They're not obviously looking at candles because they're they're pit traders. They don't have candles on their screens. They've got a piece of paper. So they've just got to watch the volumes that are coming down ticking and up ticking, down ticking and up ticking. 10 lots down, 50 lots up, 10 lots down, 50 lots up. If I say that, what's the ratio? 10 lots down, 50 lots up, 10 lots hitting into the bid, 50 lots lifting the offer, 10 lots hitting the bid, 50 lots hitting the offer. What are you jotting down on your scrap of paper? 10 lots hitting the bid, 50 lots lifting the offer, 10 bid, 50 offer, 10 bid, 50 offer. What are you putting down on your scrap of paper? Yeah, and what is that? Exhaustion, isn't it? It's exhaustion on a downtick. So without even a chart, with me telling you the numbers, you're able to then say, well, that's exhaustion. If it's 10 offered,
That's different, because if it was 10 bid and 10 offered, that's, you know, touch and go about exactly what's happening here. But if you're hitting the bid with 10 lots and you're hitting the offer with 50, the high probability is that the price is going to go to the upside away from that price, of course, because it's exhaustion. But we can't use that level as buyer support because we don't know that there's any buyers there. We've got no way of knowing there's any buyers. If I see that there's a price coming in and it goes 50 offered, 50 hitting the bid and 10 lifting the offer, and the price goes away from that, how the hell did price manage to get away if there was only 10 lifting the offer? Do you know what I mean? How the hell did price get off this bottom edge, these stopping prints? How did it manage to get off that bottom edge when there's 50 sellers heading into that price? Because obviously the buying comes in and we get a buy imbalance on the diagonal, but obviously that level gets iced out at the bottom as well, because there's obviously an ice order. In most cases, where you see these stopping prints, you'll also see ice orders. And that's when you start recognizing the value of some order flow elements, because we can start putting some of this jigsaw puzzle together. Recognizing the value of some order flow elements, because we can start putting some of this jigsaw puzzle together. But it's not just at the bottom edge. Because when I see this 20, then 14, and the price is still going up, I'm saying, okay, well, that's also stopping volume here. 20, 14, higher price. You know, because we're having to work our way back off the bottom edge now. So we're watching the selling coming in from on the right-hand side. At the bottom edge, we're watching, obviously, the left-hand side because we want to watch for that reversal. But once the candle's now going, you start watching the right-hand side. How much selling is coming in? How much selling is coming in? And is it pushing the price enough? And obviously, if it starts finding some blocking volume here, the way we define this, there's the gold gone, guys. There's the gold gone. How good was that little buy squeeze? Perfect. See it? 52.5, just traded 53.30s. That buy squeeze that we just gave out, is now worth $90 of real live cash. And it's only taken 4 minutes since I shouted it. 4 minutes for the squeeze since I shouted it, eh? Pretty good? Yeah, I would say so. Now, obviously, we'll explore into that candle a little bit further and see if we could see whether, you know, how the numbers were developing. But inside of every single candle, you can start developing stories here. There's a little bit of what we would call blocking volume here. It's not stopping volume because it's not a bottom edge, but there's a block here because the price blocks. The price blocks on the way up, not on the way down. So it doesn't stop the market. It blocks the market on the way up because it goes from 20 down to 14. If the price keeps going higher, that becomes almost a block in the market because there's a seller at that price. There's a seller coming in here that obviously has been a passive seller. They might throw up their position at some stage later on. So when we see these blocks, we can't use the top tick against the very, very top tick because obviously the candle could obviously just exhaust out and we could obviously be left with that. We can't use that. So we've got to be looking somewhere lower down in the candles. And unfortunately, these candles are all very, very small type candles. But there's a little block here as well. There's a little blocking volume here, 78 down to 33. So that's blocking volume. So we should be paying attention to that. If we were to mark off that level on the charts, there's a little block there as well. And obviously, we would be watching for exhaustion prints into these areas because obviously, if we know that there's a big buyer there, well, if we know there's a big buyer there because somebody's bought 78 lots on the uptick, that means somebody sold 78 lots passively. If the price comes back to that passive trader, there's a very good chance they might throw up their position and just get out of the trade, and that's going to put 78 lot buying into the markets at higher prices. So these blocking volumes are quite useful. There's a blocking volume just there, 179 down to 73. So there's a block just here. And obviously, what does that block provide you with? A buying opportunity if you see an exhaustion print. And obviously, you see an exhaustion print and the price obviously trades to the top edge, and at least it gives you another 5 ticks and a stop at break even. Don't worry yourself about these trades. Don't think about them. You don't have to mark them on the charts.
All you have to do is understand that they exist. All you have to do is understand that they're actually existing. Now, I want to take you along to the squeeze on the gold to finish off today's classroom. Now, what do we see in terms of blocks and in terms of squeezes? What do we see here? Anything of any particular interest? Well, number one, we see a nice order, 18 by 4 at the bottom, 54 by 117. So there is a nice order on the downtick here. So we've already established a nice order. We can also see that there's an exhaustion print into it. It'd be better if it's stopping volume, but it is what it is. The price then goes up on a 9 lot. The price goes up on a 9 lot, which means that obviously this block print here at 50, that's a little bit of blocking volume just ahead of that bottom edge, isn't it? So what happens next? It ices at the top edge, drops back down. We start seeing some exhaustion prints. We then get blocking volume. We then get an uptick on smaller lots here. And that means that we're going to be expecting that price to break very, very quickly after that happens. What happens? It breaks within 60 seconds of it happening. So you can see that little blocking volume there, that little uptick with 22 lots, suggesting that this is now going to break to the upside, allows me to step into the market with maybe 20, 30, 40 lots here and pick up 1, 2, 3, 4, 5, 6 ticks. 6 ticks with maybe 40 lots is not a bad trade, is it? $60 on 40 lot trade just made you $2,500 in 60 seconds. For an institution, that's not bad money in any institution. It's not bad money. For a retail trader, $60 in 60 seconds means that you're making $10 a second. Well, if you can make $10 a second consistently right through your day, you'll be a very, very rich trader. Why there is a nice order? Yep, we covered that yesterday. But if it's still not clear, if prices are down ticking, we should always have the bid offer spread based around this simple matrix. Now, in terms of liquidity, if you're going to buy at the market, you're going to be buying the market up here. Remember, this is a buy market order here, okay? It's going to pay that price. So if somebody wants to buy at the market, they're going to pay that price. If somebody wants to sell at the market, they're going to pay this price, yeah? And obviously what that means is if you do a trade at the market, buy at the market, then sell at the market, you would automatically lose the bid offer spread. You'd lose the one tick trade. So when we understand that, that's the diagonal that we're dealing with. This is the diagonal that we're always dealing with in terms of order flow, because this is how market makers make their turn, obviously. Now, as we can understand this, then obviously what is this order here? Well, it's obviously a buy limit. It's obviously a buy limit order, because if you're selling at the market, you're obviously buying limit orders there. What is this trade? Well, it's obviously a sell limit order. Now, in that type of situation, you've got to say, well, if normality is trading, if somebody comes in and the only thing that can move price, for example, if I'm sitting on the liquidity order book here, and there's somebody else sitting on the liquidity order book here, and there's, for argument's sake, I've got 50 lots waiting on the buy limit order, and this guy's got 50 lots waiting on a sell limit order, yeah? Everybody with me so far? So this is limit order books. This is what you're seeing on Bookmap, is this limit order book here and this limit order book here. That's what you're seeing on Bookmap. The difference is the bid offer spread between these two. So we've got that bid offer spread here. And you can see that that's correct because we've got sell limit in the top right-hand corner and buy limit at the bottom left-hand corner. So there's 50 lots sitting on the buy limit order book. There's 50 lots sitting on the sell limit order book. Now, this chart, these candles here, which are called footprint charts, haven't got anything to do with the limit order book. We're not seeing the limit order book here. We're seeing the actual transacted volume. But obviously, if we were to then dissect what happens in here, if somebody comes in and says, no limit orders are going to get filled because, well, how can I fill any limit orders? How can I fill any limit orders just now? It's impossible, isn't it? Because I can't put a limit order above the market. I can't put a limit order above the market because it's just a market order. Do you know what I mean? So nothing much happens. Nothing much happens here. But obviously what does happen is that, there's some people come in, a seller will come in and sell 10. So in terms of this green candle, it wouldn't be a green candle. What would happen is the candle would be red, wouldn't it? So somebody comes in and sells 10, there's a red candle because it's going to downtick into this price level here. So you're going to get this candle that's coming in like this, and this candle is going to look like what? It's going to look like that, and it's going to have what in it? It's going to have 10 lots on this side of the chart here, isn't it? It's going to have a 10 lot here on this side of the chart because that's somebody selling 10 lots into that 50 lot limit order book. So that's a downtick. It's going to be a downtick because the last traded price is one tick lower than it was before. So what's going to happen next? Somebody says, okay, the limit orders are still holding. There's now 40 by 50. And somebody comes in and says, I'm going to buy 20. So what does this candle look like? Well, if they're going to buy 20 at market, it's going to uptick into that other price, isn't it? Because that's where the market price is. So that's now going to have what? It's going to have a green 20 just here, isn't it? It's going to have a green 20 now on that candle. And the candle's going to change color. It's going to change from red to green because the last traded volume was on an uptick. So the candle's moved back to the upside. So it's going to be 10 by 20. And that's what the candle's going to look like, isn't it? That's got to be what the candle looks like here. So if I look at this situation here, I can see that this 10 here, the seller of 10, the buyer of 20 here, that's called delta imbalance. That's what we look for in delta imbalance, is we're looking at the diagonal imbalance that's happening, sellers against buyers, sellers against buyers. And when we see a delta imbalance that's strongly favoring the buy side, we can obviously use that, but obviously if that gives you a positive delta, doesn't it? The delta on this must be plus 10. It must be plus 10, and it's a green candle, so the delta's positive, the candle's green, we're getting buyers coming in, it's basically sellers are exhausting at the bottom edge, things are all good. So on that basis, how do we populate this bottom right-hand corner? How do we populate this bottom right-hand corner? To populate this bottom right-hand corner, obviously, what has to happen is there has to be a buyer comes in. There has to be a buyer that comes in. And, because obviously buying is on the right-hand side, there has to be a buyer that comes in that gets immediately taken on by the seller, but then the price gets taken higher because it's a green candle. And that's what we're looking for. We're looking for the green candle. So a buyer must be coming in here, but obviously because it's in that box there, and it's almost impossible to exist because the buyer on the right-hand side here is a market order. So if a buyer comes in, it's a market order. That's suggesting there's a downtick, but there's no sellers below it. So for example, there's no sellers below here, and there's nobody trading below here. There's been no trade at all below this level, but obviously somebody comes in to buy it, and we get, for argument's sake, another 25 lots filled here. Well, why is there no trade down at the bottom tick here? Why do we not get any sellers? Because, well, there's just obviously no sellers. Any seller that's coming in now is getting absorbed. So the buyers and the sellers are effectively the same price. And the only way that that's possible is if there's an algorithm sitting on the book. So when I see that buying and selling at the same price at the bottom edge, and there's no downtick into this area here, and it's a green candle, because every candle's got buying and selling at every price. Look, every single candle's got buying and selling. That's not what we're trying to show here, because that buying and selling can happen over the course of 5 minutes. But if the price is left behind here, there must have been some sort of algorithmic type buying that stopped the market going any lower. Otherwise, there would have been a downtick
for, you know, for a 1 lot or a 2 lot or whatever, a 3 lot, a 5 lot, a 20 lot, there would have to be something on the left-hand side of the book, because that's what would normally be expected. That's what you would normally expect to see, isn't it? On the left-hand side of the book, you'd normally expect to see a small number and a 0. That's what everything on the right-hand side of the book at the top edge, for example, that's what you would expect to see. This 37 and 0 is normal. This 12 and 0 is normal. This 19 and 0 is normal. This 1 and 0 is normal. This is not normal. 46 and 12. That must mean that a buyer came in at that price. An algorithmic type buyer that stops the price making any progress to the downside. This must be an algorithmic buyer at this price. This must be an algorithmic buyer at this price. Because the price is closed above the level. And if it's forming just now, and this is just buying and selling, going up and down this, it doesn't necessarily mean, but it should still have that 0 in the bottom corner. It should still have that 0 in the bottom right-hand corner on a buy trade and the 0 in the top left-hand corner on a top edge. When a top edge gets put in, that's just the diagonal that works, isn't it? It's from the 0s to the 37, so that corner's empty. And it shouldn't be populated by anything unless the price is going higher. Well, if it gets populated and the price doesn't go higher, that's got to be an algorithmic sell. Does that make sense? No? Possible? So here's an example on this gold again. Take a look at this candle here. It's a red candle. It's a red candle. So if this is a red candle and somebody's came in on this red candle and somebody's bought, but somebody's also sold. If somebody sold here, where the hell is the buy? Where's the buy side of that trade? Where is it? The buy side of that trade, if somebody's sold here, if somebody's done business on this book, there should be a price up here, shouldn't there? There's got to be a price up here. There's got to be a price somewhere in this area, like that 37, 150, 76, 98. There's got to be a price up here if somebody's on the book on the left-hand side. There's got to be somebody on the book on the right-hand side. That's how the market works. And if there's nobody on the book on the right-hand side and the price is traded down, how the hell did that happen? The only way this happened is that there's some sort of algorithm that's actually absorbing that trade. And if there's an algorithm absorbing that trade, does anybody else see what else happened on this candle? 49 lots by 28. Stopping volume. So we've got a nice order, potentially. It's also stopping volume that then gets tested on what? Exhaustion prints. 54 and 18, 17 and 7. Do you see how the story develops here? Do you see how that story develops, guys? I mean, is that starting to catch hold now? Is that starting to catch hold? If this is stopping volume and there's an algorithm sitting on the book and it then exhausts and the value line's declining, the green line I think is the euro. I'm pretty sure it was a euro put on it. And the green line's declining. So we know that the dollar's putting a bid in. That's bad for gold. And we get this formation forming here. Can you see that it would be quite possible to take that short trade on the book? You could have said, okay, I'm going to take a scalp trade off of 52.9, 52.8. I'm going to go short off of these levels, and I'm going to see if I can squeeze the next key level, which is this price here. And then we've got the next key level. Remember, we had that big stopping volume below the market here, so we've got to try and get 52 offered. Well, if you're in at 52.80, a rejection of 52 is it's not the end of the world, is it? A rejection of the 52 here is not the end of the world because you're still going to make 50 bucks in a trade. Agreed? So what happens? It didn't go offered. It didn't go offered. Why did it not go offered? Because this level started to get frozen. Now, we don't know it's frozen because it's a down candle and it closes at the low. So we're obviously watching it thinking this should break.
but it doesn't break. It freezes, and the price then leaves behind that stopping volume print. It leaves behind that print, doesn't it? Because stopping volume coming off the bottom edge would have that 67.55 here. So that's a slight stopping volume, and it's icing up. And if that's stopping volume and it's icing up and then it goes up tick, you just say, you know what, I'm going to take the trade off at 52.30. I've made 60 bucks. Fair enough. It's not what I expected. It's not what I hoped for, but I've made 60 bucks on the trade. No harm done. And obviously what's happened next is the prices just came back up to where? The stopping volume that we had in the background. Stopping volume that we had in the background. The price comes up in ices at the top edge. How do we know that ices? Because it's an up candle? Well, we know it ices because the price then trades away from it, the next candle. So that level there had iced up a little bit, traded away, but this unfortunately iced as well, and then we've got an exhaustion. So there's not a lot of value on the buy side or the sell side to really work with at the moment. But that's okay. That's okay because your trade made 60 bucks. You got away from the trade nice and easy. You had a very, very simple combination of setups, value line going down, ice orders here, exhaustion prints. You were able to pick up a 2 lot, 3 lot, no problem. You made 60 bucks on a 2 lot, 3 lot. It only took you 4 minutes. It only took you 4 minutes, and you were walking away with $100 in your tail on a 2 lot. And then you're getting ready for the next perfect setup. And the next perfect setup, I'll take you back to the next perfect setup. It was this one. Because look at the value lines. They're all going up. Then we get this iced up order at the bottom edge here, the green candle. We get the green candle at the bottom. We've got stopping volume in the background, and then this exhaustion. And the value line's going up, and you say, well, that's a great buy trade at 52.10s. I've got a target price at 53.10s. Let's see what happens. And then all of a sudden you end up with 53.40s, and you say, that was good. I enjoyed that squeeze. I've made another $100 on one lot, $200 on 2 lots, and you're sitting with another 200 bucks on that little scalp, and you say, what's next? And what's next was that short trade, another $120. You've done $320. It's only taken you around about 15 minutes. You know, it's just scalping the order flow to try and find the right setups, about trying to find the right situations, the right stories, the right value to try and get your narrative right. And then looking, remember, if you're just looking at order flow, you're going to be asking yourself the question here, do I take that? Do I take it? Do I take it short? But you're not just trading the order flow, you're trading a narrative. So when I see the green line going up like this, it's not particularly clear, but the green line's going up, I'd be more inclined to be looking at this and saying, if I could get a downtick into a spring level, perhaps down here, and then I saw that stopping volume icing up of the levels and exhaustion print retests, I would be looking to then test this squeeze at the top, and I'd be looking to buy into this as a scalper. That would make perfect sense to me. But you've got to make sure that the narrative fits into what you're then seeing in terms of the order flow, and if it does, well, deal, get involved. Say, I'm going to take a piece of this action, thank you very much, I'm going to see what happens. I'm going to take a little piece of this action and try and climb on board. And I'm going to see if I can make some money off it. I'm going to see if I can make some money on the squeeze, or I'm going to see if I can make some money on this, whatever happens next. Because when you go back into these charts, this is oil right now on the right-hand edge. Oil on the right-hand edge. What do we see at the bottom? Nothing. We saw exhaustion on this candle here. Price opens above it. You then see this, this exhaustion. We have an ice level. You then see this exhaustion, and we have another ice level. This price comes down, ices up very quickly, and we get a buy response. Well, these are all possible buy trades because obviously the green line is going up at this stage. So the narrative is we want to only be looking for the buy side of the trade because the value is going up. We're only watching the buy side. I'm not really interested in trying to find any top edge selling or anything like that. I'm going to be paying attention to it because I want to see how far my long oil trade can go. And obviously I want to try and start squeezing some of these key levels so long as that green line keeps going. And I want to try and step into the markets based on some of these stopping volumes, not necessarily based on exhaustion, but based on some sort of blocking volume of some sort. If we're looking for blocking volume, there was a little blocking volume here, 39 down to 26. So there was a little block here. So we could have said we're going to go long at that stage. Take the price bid, and all of a sudden you've just made yourself $140. Stage. Take the price bid, and all of a sudden you've just made yourself $140. And that's what you've got to try and be seeing, isn't it? Because if I take you along to the last squeeze on oil, this was perfect. Take a look at the green line. You see it? Take a look at the green line at this stage. Look at it. It's tearing off to the top side, and you've got an opportunity to step into this market. Now, that's an exhaustion print. That's an exhaustion print. But obviously what happens on this red candle is it trades down and then leaves the bottom edge. You might be saying, but a red candle, but if the open and the close is here, if that closed one tick higher, it would be a green candle. So just because it closes one tick lower doesn't make this any less valuable as stopping volume, and that's what you've got to try and understand. Stopping volume stroke has ICE orders. So we understand that this is a possible ICE level. And obviously, if the price exhausts into this level, which it does, 44 by 23, this is a very, very obvious opportunity for you to pick up some longs for the squeeze of that top edge. And you can see if you picked up some longs here at 47.66, you can see what happens next. The price trades all the way through to 47.88 for $200 profit in about 5 minutes. $200 profit in 4 or 5 minutes, scalping the order flow as it tries to find a way through that level, which it ultimately fails doing. You can see how this process should develop, guys. I mean, it's not an easy process. It's anything but an easy process. We got a level 2 seller coming in at that price, that because it took it out, just touched the level, took it out. And you say, okay, we've got a level 2 seller. What am I looking for? Well, if the green line starts dropping, I'm going to be watching for some sort of a stopping volume to trade up. When we haven't had any, 44.55, 334, 535. We haven't had any stopping volume yet. So we haven't seen any reason. There's no ICE orders. There's no stopping volumes. We haven't really seen any reason to be getting into the short trade. And obviously the euro's turned back up about a little bit just now. So your narrative is, I'm just going to have to wait and see what happens next. So order flow trading isn't about just the order flow. It's about recognizing the key levels. It's about reading the volume. It's about reading the deltas, and it's about reading the footprint. You can't trade order flow by just watching the footprint without trying to pick up why the trade might make sense, why the order flow makes sense, because it's the why the order flow makes sense that stops you just getting a frazzled brain looking at every single twist and turn on your order flow and thinking that's a top edge, that's a bottom edge. Oh, bloody hell, it's back to a top edge. Oh, it's back to a bottom edge. But your value gives you a good idea about whether there's a reason for a bottom edge. It might be a bottom edge in terms of order flow, but is there a reason why it's a bottom edge? Well, if there is, then I'll trade it as a bottom edge. I'll try and take advantage of the order flow elements. I'll try and take advantage of somebody sitting on the book absorbing. I'll try and take advantage of stopping volumes, and I'll step into the market aggressively as a buyer. And that's going to be the massive difference between the good order flow traders and the not so good order flow traders, which is the majority, I'd imagine, of retail trade is not very good at order flow trading because they don't understand these elements. They oversimplify it to just the book map, or they oversimplify it just to the footprint. And they're missing all the other key elements of what we're trying to find and what we're trying to look for in these types of trades. Any questions on that, guys? So what we've covered today, we've covered the ICE orders again. We've covered the idea of the ratio, the book ratios. So how to calculate the book ratios. Pretty simple stuff. We know how to, without indicators, we know how to establish whether there's stopping volume on any candle. Without indicators, we've been able to establish whether there's exhaustion prints at any stage on the charts without indicators. And because we can trade this without indicators, we can obviously start understanding that there's, you don't need to have 1,000 different things on the charts. You don't need to have an indicator that only has a certain threshold parameter. You can see it all over your chart. You can see it all over your chart, and you can try and make sense of these types of indicators. You can make sense of what you're seeing on the screens as it happens live on the screen at the moment, live on the screen. And once you can understand live on the screen what's going on, trading should start to make some sort of sense. Because when you see exhaustion prints on the bond, for example, because the bond has got this brilliant personality about it that has this a very, very simple kind of quality. Look, empty chart, no value lines on the screens, bottom edge, icing up, exhaustion print of a 2 lot, icing up, icing up, icing up, get some buy side, guys, because it's now exhausting at 1 tick lower. And you can see here that this price is going to go north. And you just watch these green blocks. See the heavy green blocks? You see them? If I join the dots, try and see what I'm talking about. Heavy green block, 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 heavy, heavy, heavy green blocks, heavy green blocks, heavy green blocks. When did the green block ever downtick? From the lowest green block. When did it downtick? Never once downtick, did it? Never once did it downtick. And that's the movement of value higher, isn't it? So when I look at this red block, red block, red block, red block, red block, and then obviously what happened was it started to downtick, come off the bottom edge, and then we got the red block into the green block, upticking into the next green block. And you say, well, that's it. That's a bottom edge. That's a bottom edge getting put in right there. It's got to be. It's gone green. The green blocks are developing, so that should be the bottom edge print right there. I should be able to find a buy opportunity away from that level. At the top edge, it goes green block down into red block, so that should be a selling opportunity on bonds. If I take you along a little bit to the left, do you see where the buying opportunity is? It goes down into the red block, red block, red block, up into the green block. So when it goes up into the green block, that should be a buying opportunity in bonds. Should be. And when we go along to the left-hand side, red block down into another red block, that should be a selling opportunity on bonds. What happens? Not very much, but the bond price ultimately drops. You can see we never get an uptick at that level. It drops down here, it goes back up, drops down here, it goes back up, kind of sitting in the middle. Yeah, started to tick back up again. So that's the reversal out. You can see that we've got an uptick on the green box, and that's obviously going to be, you're going to be watching now for volume transition to the upside. And if you stop a second and think about those bond trades, just short term, how would you have done with those trades? Pretty good. You'd have maybe have caught a little 1, 2, 3, 4, 5 tick trade there. You'd have maybe caught 5 ticks, $150. And then you'd have maybe caught 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20 ticks to the upside, $600. $600. And then if you started to sell that top edge, you might have been able to pick up 1, 2, 3, 4, 5, 6, 5, 4, maybe 4 ticks off the top edge. That's okay as well, isn't it? And all that you're doing is you're watching for the order flow transitions. All you're doing in that type of situation is you're just watching for the transition of the volumes, watching for the POC moving off the top. The POC, remember, is the brightest color candle, part of the candle. It's just a way of reading volume. So the highest volume is the lightest green. The highest volume is the lightest red. So when you see the highest volume, you can watch for those transitions of volume. In terms of bonds, that's the direction you want to be trading. Because if volume is building at a higher price, the price will go up. If the volume is building at another higher price, the price will go up. Eventually, the price will exhaust out and the price will build on a volume on a downtick, in which case you should obviously be trying to work your sell side of the trade. So in this type of trade here, when I see volume and I see volume and I see volume here, so long as I don't get volume in this area here, I should obviously be still working this to the upside, which means any other trade should be a buying opportunity. When I've got this volume here, I should be able to buy this box. When I've got volume here, I should be able to buy this box. When the volume starts transitioning up here, I should be able to put a buy order here, buy order here. And as the volume transitions up to this box here, I should be able to put a buy order off of that level because I shouldn't see any volume building at that price or lower. If it does, I'm in the wrong trade, as it happens here. The price goes up, the volume builds here, so I shouldn't be able to see any volume building below it. It does build below it, so that gives me a selling opportunity, and what happens is the price then sells off. That's the transition of POCs, and that's going to be the subject of tomorrow's classroom rather than today's classroom. Why we expected a front-end flattener? Because of the shape of the 10 spreads, Miguel, because when I'm looking at the 10 spreads last night, I can see that there's a very, very obvious value divergence in terms of where the fixed asset traders were trading. And, when I was looking at that, thinking to myself, these guys are going to have to take this market up a little bit off of this. And, I had a feeling that that's usually going to transition into a flattener on the curve. So let me see if I can find the chart that's relevant to that. So there was two pieces of information that were giving me something last night. Two pieces of information that were giving me something. So here's the bond here. So the first thing should be pretty obvious. Number one, the first thing should be pretty obvious. Coming into the close, number one, coming into the close yesterday, we were buying equities. So the equity at the close here, Miguel, was bullish. You can see the candle there from yesterday's close, yeah? If you look at the tweets from last night, you'll look at the equity tweet, and you'll see that we were buying off the settlement price, yeah? We were going green zone long equity trades, yeah? Everybody remember that? So here's the equity price. Here's the equity trade here. So we're buying off of this. We're buying off of this green zone equity trade. Remember, we just came off the 25.50 level, which is also an enormous support level, Miguel. Remember that. 25.50 on equities has got to be a humongous support level. Agreed? We've already established that even from the weekly chart. Remember this? Remember this chart here with that big surge in terms of the options at 25.50? So if I know there's going to be a huge amount of support for equities at 25.50, and I therefore know that equities are probably going to be going up, and then following that, equities open in the green zone, what do you think the curve's going to do? Is it going to steepen or flatten? Yeah, it's going to start flattening. So what we're expecting is we're going to start watching for that happening on the charts. So when I start buying this black candle here at the bottom, when I'm starting to look at this and look at the shape of the markets, I haven't seen that flattener yet. Because how does the front end start to show up? Because if the back end is still lagging behind the front end, there's still something that I'm expecting to happen, and it's called what? In terms of bond trading. If the back end is still kind of lagging behind the front end here, we're expecting the curve to start twisting for that flattener. So how does the curve start to twist? Well, the front end either starts dropping really hard, or the back end has to rally against the front end. Does that make sense? So either the blue line and the red line has to drop really hard, or the black line has to rally really hard. And if it does that, then I've now got the curve twist, haven't I? I've now got the twist. And now what I'm expecting is a back end flattener coming in from the front end flattener that we've just seen coming in here. So when that market starts to flatten here, you can see that we get a flattener at the front end. The back end has accelerated a little bit through that process. You can see the black line here is at significantly new good highs. The red line is less than it was before. That's the front end. So obviously in that type of scenario, I've now got what? A grail sell trade on bonds, haven't I? Because if that market's starting to flatten, what must the market think of equities? If that market's going to flatten, what must it think of equities? And why would they think it's bullish? Why would the fixed asset traders think the market's bullish on equities? Two reasons. Well, just outside of fixed asset markets, outside of the fixed asset markets, why would the fixed asset markets looking at equities think equities were bullish? There's two very, very simple reasons. Because there's a huge fecking hedger off the 50 level that's already came into the market yesterday and bought the equity price on a downtick. So we've already seen that huge equity buyer coming in. And secondly, equities are going up. It's that simple. Equities are going up, and that movement off this bottom edge price here at the close, that movement off the bottom edge price on the close on equities is going to flatten the curve in most cases. And therefore, there's a very good chance that that flattener is going to start resulting in some top edge grail selling of bonds. And that's exactly what happens, the top edge grail. So it's not anything Nostradamus-like, Miguel. It's just simply reading the fact that equities have caught a bid. Equities have got a great support level below them based on the fact that we've got that enormous monster wholesale price area of 50 right below us. Prices have traded to that level and the big buyers came in and took the market bid off of that. The market is still bid. And on the basis that the market's still bid and squeezing these previous swing highs, the only direction this curve is going to go is flat, is going to go flatter. And obviously what happens is that the curve doesn't really go flatter. What happens is the curve actually starts to steepen. And the back end starts to flatten. Do you see the twist in the curve coming back out again? Does anybody see it? The front end steepens, the back end flattens. You see that, guys? On the right-hand edge of that chart, I'll take it along to that point just here. You see that twist in the curve here? On the right-hand edge of that chart, does everybody see the twist in the curve? Can everybody recognize that the red line is going up, the blue line is going up, and the back end of the curve is going down? Does everybody see that? That's a twist in the curve. So what's just happened in that analysis, guys? What's just happened? Are you still really bullish equities, or what's happened to your thought about equities at this stage? What are you starting to think? What are you starting to fear? What are you starting to get worried about here? What are you starting to get worried here at the cash open? Are you really bullish equities on the cash open? What do you think? Are you really bullish equities on a cash open? Now that you've seen a front end, steepener. Now that you've seen a front end steepener, are you really bullish equities? Bearish equities. Because what's going to happen is the back end's going to steepen. You're going to find people rotating into bottom edge bonds, because if the back end steepens, people are buying ZN. And if people are going to be buying ZN and equities are at the top edge, what do you think they're going to be selling? What do you think you're going to be selling at 2:30, 3 o'clock? What do you think at the top edge is going to happen, guys? What do you seriously think is going to happen to this black candle? What's going to happen to the black candle, which is equities, is you're going to start drawing a line on your charts, watching for the opportunity to step into some sell business, and then nailing it. Boom. Like an absolute crazy. and the price on equities sails off like an absolute cracker. And it was all predictable before it happened because the curve started to twist. You see it? The curve started to twist. The red line goes up, the black line goes down, and you go, oh, top edge, cash open. That's a bit saucy. I want a little bit of that top edge liquidity sell side because I'm getting a twist in the curve. And now the curve is dictating the fact that top edge equities are a shocking long trade. And what do we do with our equity chart? We go into the equity chart and we start doing what? We start looking at the order flow for an opportunity to maybe step into that curve. We look for the order flow at that cash open and say, can I find any evidence on that retest at 3 o'clock? Can I find any evidence for that retest at 3 o'clock that's going to give me something to get my teeth into for a sell trade? And the answer was, yeah, you got a level 2 seller. You got a very large pin rejection on the deltas. Take a look. We squeezed the level perfectly. There's a squeeze trade. Squeezed the level perfectly. Look at the pin rejection we got on the deltas. Unbelievable. Price traded up. Level 2 selling. Price came back down. You could have sold below the volume, and then all of a sudden you're sitting on an enormous profit. And you haven't, all you've had to do was recognize the steepening of the front end and the flattening of the back end and say to yourself, that's exactly what I expected to happen to that equity. It's not a surprise. It doesn't take you by surprise. It doesn't catch you out. It doesn't catch you buying top edges. It catches you trying to fade that top edge because it's the right trade to do. And then all of a sudden equities obviously tear off that level there. And obviously the reason why we got a bounce was what? What was the reason equities bounced down here? $16 to 16.30. Why did equities bounce down there? A lot of people say, oh, because there was institutional buying. Why was there institutional buying at 16.30? Why was there institutional buying at 16.30? It's very close to the 50 level. But why else did they decide to defend it? Why else did they decide to defend it? Look how flat the curve just went. You see it? It's not a twist in the curve. But look at the curve, guys. Look at the curve on this downtick on this equity. I'll try and get it so you can see it. Look at the blue line. Look at the red line and look at the black line. We're getting a flatness of the curve as equities downtick. Why the hell have we got a flatness of the curve? Why would fixed asset traders flatten the curve on a downtick in equities? The answer is because they don't think the downtick on equities is actually going to hold. And if the downtick on equities isn't going to hold, where the hell's the trade? Well, either you're going to start buying some bonds, you're either going to start selling some bonds or buying some equities. You're not going to do both the trades. You're not going to start taking the two of them on board, but you're going to be looking at this bond and saying, I've got a great opportunity to deal that grail top edge. I've got a flattening of the curve. That flattening of the curve at the bottom edge of equity suggests I'm expecting equities to find a buyer. Because the fixed asset guys think that there's going to be a buyer on equities, otherwise they've got the curve wrong. In which case my trade could be a curve trade. Because obviously if equities just kept selling off, this curve would go instantly buy side, wouldn't it? Instant. As it turns out, whether you bought equities or whether you sold bonds, you made money. So when you start breaking this down, guys, everything becomes predictable. Everything has an incredibly high probability, and if it's not, you shouldn't be in it anyway. None of this stuff is magic crystal ball stuff. This is just about analysis, proper institutional analysis of properly reading what's going on in the marketplace. If I know, for example, equities have got a buy off of the bottom, I can use that to get short gold. Obviously, I would assume if I'm going to get short gold that I need to make sure that the euro's getting a sell in it as well. But obviously, if the euro does have a sell in it, then why the hell shouldn't I get some sell side gold on the basis that there's going to be buyers of gold because equities are dropping. So I'm going to be selling to them on the basis that I know that the equity drop is going to hold based on the curve that I'm seeing in the bond market. So I can make a very clever, very that I'm seeing in the bond market. So I can make a very clever, very informed trade decision on gold. Now, if the euro dollar is rising at that stage, my gold trade gets taken off the table and I simply focus on bonds or equities. But if the euro dollar is dropping and the gold price is upticking because of the downtick on equities, that gives me the perfect gold short, doesn't it? It gives me the perfect scenario for a GC short trade. And obviously, when I know that that's happening in this area here at 16, we know the equities are going to go bid here at 16.30. So obviously, we would start to hunt for that trade around about then into the top edge if we've got a top edge, if the euro's going offward, Now, those elements all have to line up, because if they don't line up, we've not got a trade. I mean, if we're miles away off of that trade and it's already done its business, there's no trade, is there? This is what gold looked like. The price had came up to 16.30. Somebody had already started to sell in it, but the euro catches a bid, goes offward. I'm looking at that saying equities are going to go up, so I want to be selling into these areas. And you can see that the idea was to try and squeeze this 12.51 level. Didn't happen, because what happened was equities failed to catch, and the euro obviously caught a little bid at that stage, and obviously we couldn't get away from this downtick, but we still made some money on it. But the euro was never particularly supportive of the gold trade, and therefore we just had to pass on gold and focus on bonds, which was good because we got a decent little sell off the top edge on bonds. So that's a long, kind of drawn out narrative to answer Miguel's question, but I hope you can see that by answering Miguel's question, that it's not something that you guys can't do. It's something that if you just take time to practice the narrative, that all of a sudden you'll be able to buy equities and sell bonds, or sell equities or buy bonds at specific places on the chart with absolute certainty about what's likely to happen next. Absolute certainty, because obviously you wouldn't do a trade unless you were absolutely certain. It doesn't mean it's going to work. Something can change in the marketplace the minute you take the trade on. But the point is, you can tell what's going to happen, and sometimes that analysis, that simple little piece of analysis, allows you to make some great decisions in the marketplace. This flattening of the curve here isn't an awful lot of use to us just now. The back end is starting to steepen. What we need to see is that back end then flattening, and then we could take advantage of an uptick on bonds, or a downtick in equities, or potentially an uptick on gold if the euro's been dropping at that stage. So you've got to develop and round out your narrative and keep reanalyzing your narrative on a regular, repeated basis right through the formation of your day. And most of your time is spent looking at these numbers, looking at these paddles, analyzing what is happening here, what is going on, what can I make of this, taking a look at the bigger picture and seeing what the big macro trade is, never losing sight of where the big levels are, never losing sight about previous swing levels, never losing sight about what's happening on some of the other markets. And if you can do that, you're going to be consistently successful in your trading, aren't you? You're going to be, every single time you switch on your screens, you're going to have a far better chance of being successful than anybody else that you know in the retail space. Anyway, guys, packing up at that, starting to lose my voice. It's 6:10. Thanks again for the questions. Thanks again for the inputs, and we'll try again tomorrow. We'll see if you guys have made the narrative in your bond markets. If you've cleared your narrative nice and easy, we'll come back in tomorrow and we'll go through it all and start all over again for Wednesday. In the meantime, thank you very much for your time and questions, guys, and I shall see you tomorrow. Ciao for now. Adios, amigos. Arrivederci. Auf Wiedersehen and spasiba. Different kinds of pricing, not the price that's on the charts, but different kinds of pricing. So when we understand that, we can start to look at things like this divergence here. And one of the things you'll be able to recognize is that the market maker was not bullish when the price broke north. And then there was a large block order. See the little blue square? That's a large block order buyer at that price. And if you're going to trade that bearishness and you see a large block order, put a sell stop order one tick below that buyer right there. And you can see that you could have got in at 76.02.5 and it traded down to 96s. So you'd have been able to take advantage of what was ultimately a very, very nice little sell trade. It's a scalp, it's an order flow scalp, but that's what we're talking about, order flow scalping. So when you start putting combinations of stuff together like this, you can start to see, now you can obviously see that the volume, where the volume was, we can see where all the volume on each candle is. That's what these orange squares are. That's just volume on the candle. That's called volume node. And obviously when we start seeing divergence, see that volume block just there, that little square? That means that there is a volume increase on a block trader. So obviously if you get that volume increase, you could put a sell order, a sell stop order below that level and watch for the price to then break that level. When it does, that could take you into the trade, or you could just have broke the previous high volume. So it's one of those things that you can start to see as the trade develops out. You can start to see some of these trade ideas. You can see the market maker still isn't bullish here. Look, market maker hasn't even blinked at that volume going up. And look at what's happened to price in the next candle. It's came straight back off again. Straight back off. Anyway, tomorrow, let's just recap what we're going to be doing tomorrow. Tomorrow we're going to do a recap of everything. We're going to do a recap of the classroom. We're going to reconstruct the S&P chart from scratch. We're going to put the commodity risk line on. We're going to put the program buy and sell line on. We're going to look at the quality spread line. We're going to put that on as well. We're going to look at the tick. We're going to look at the prem. So that's the starting point. So that's the background of the model built. Okay, so we're going to rebuild the whole S&P chart from scratch tomorrow. In addition to which, we're going to then look at fast and slow. We're going to look at the order flow processes. We're going to look at key structural levels on the S&P. And obviously, all of that is going to be taken into maybe the first half. It's not going to be long because we're just going to rattle through the building of the model and rattle through the fast money, slow money processes, rattle through the concepts of level 1s and level 2s in the interns exercise. So we'll be able to compress all of that into maybe the first half hour. But you'll get to rebuild the model again from scratch, the model that we've been showing you, the S&P model that you've got on the screens right now. Not this model, but the S&P model that you had on the screens earlier. So you'll rebuild this model right here. All of these lines, you'll be rebuilding all of these lines to get a good idea of what they are, where they are, what they're doing, and all that kind of necessary stuff. And from that basis, we'll then go and look at some of the other elements that this can add in terms of some of the references that you found, reference areas like level 2 top edges, level 2 bottom edges. And we can look at the market maker's pricing of those by adding in something like David's PRC indicators. And we can start looking at the Voltic indicator as well. When we start seeing the PRC is bullish, the Voltic then comes in and we start seeing some institutional algorithmic activity at a price that we're also interested in being a buyer anyway. And that should make perfect sense. Tie the two pieces of the jigsaw puzzle together, and what have you got? Absolute perfection. If you look at that bottom edge, guys, look at this chart here. This is what the value line was telling you at the time of this bottom edge. We've already identified from this chart that the market maker is bullish. We can see that the PRC is going up. It's not going down, it's going up as the price drops here. We can then see the volume comes off the trade. In other words, as soon as the blue line starts going up, we know we've just entered a buyer's auction. I don't want to try and buy a bottom edge if I'm in a seller's auction, because that means I'm going to have to stand in front of an awful lot of selling as a retail trader. You don't want to be doing that. So we're now waiting for the blue line preferably to diverge or at least rally. If it's not going to diverge, and it's not going to diverge, at least to turn back up and rally. That puts us into a buyer's auction. And the final thing that we're looking at this point here is we want to see if there's going to be any commercial activity for this. Because obviously if there is, we're in good shape. If there's a big sell block order in here, we're in good shape. We could use a buy stop order. And as soon as we start seeing an increase in activity, you say, what the hell is that increase in activity? And you look at your charts here, the blue line is up, the red line is up, the tick extremes are pretty extreme. And you say to yourself, it's also a level 2. It's also a level 2. So you know what? I'm going to take a level 2 buy trade. I'm going to put a buy stop order 1 tick inside that, and I'm going to buy at 92.25 on the S&P. Or if you're trading the NASDAQ, you could put a buy stop order just here, just 1 tick above that volume node, because that means that volume's on the wrong side. So you can take a buy stop order here, boom, the money's in your bank account. If it was on the S&P trade, of course, what happens is that money just, the price just obviously explodes to the upside as well, and you make a very, very nice profit as the price rallies through to the top edges. So combining pieces of the jigsaw puzzle. Look, there's another trap buyer. See the trap buyer right there? Was the market maker bullish on that one or bearish? In real time, was the market maker bullish or bearish on that candle? What do you think? Was the market maker worried about that buyer at that top edge? Or was he not worried at all? Market maker was saying, bring it on, bring it on. Sell trade. 76.01, 75, 76.0150 maybe. Sell stop order just below the bottom here. If the price keeps going, you don't get taken in. The price immediately sells off through that sell order and drops like an absolute stone shortly afterwards. So if you can see that that's a bearish trade, when it happens, you can execute, can't you? I mean, it's just about executing now. It's just about saying, you know what, I can see that that's a bearish trade. I can absolutely see that it's a bearish trade. I just need to turn up now. I just need to show up and have confidence that I'm on the right trade by checking my values again and making sure that my values aren't massively bullish at that stage to try and take advantage of. Now, this is the S&P. We were looking at the S&P and the NASDAQ, remember? But there is a very definite bearish divergence off this top edge, isn't there? Look. Nobody can tell me that there isn't a bearish divergence up here, guys. Because there is absolutely a bearish divergence up here, isn't there? So nobody can tell me that they can't see that bearish divergence because it's visible. Doesn't matter which line I draw a diagonal across, that it's always a diagonal to the downside. Therefore, there is a sell trade here. And you've been working it on this chart, selling this, and you're now working it to the downside. You're mindful of whether the value is improving, which it is, I suppose. Yeah, there's certainly some sell programs still in play. Market makers starting to get a little bit bearish, which is good news. If this turns out and the price drops, then obviously you just distribute. I don't think the other ones are terribly bearish. So you'd be obviously mindful of this bottom edge to book some profits into. You'd just be careful to book some profits into this area here and make sure you're obviously looking for the signs to see whether you should book the rest of your profits or whether you should hold on for the trade to carry on sell side. It looks okay for a sell at the moment, but we've lost the commodities for the time being. Market maker still bearish as we squeeze down into the bottom edge. Now, what's important about this sell trade? What's important about this sell trade is we'd already live discussed this sell trade. So if you understood this sell trade, you would definitely understand this sell trade, and therefore you could have executed on this one based on the fact that we are in a seller's auction, based on the fact that the market maker is bearish, based on the uptick, based on the volume surge at the top edge, and you could just have put a single little sell stop order there, and that's enough, guys. Those types of trades are enough for you. You only need 1 or 2 of those trades every day. You don't need 20 of them. You don't need to buy every single swing or sell every single swing because, you know, a lot of the times you're not going to make any clean decision about exactly what's happening. That's why you took profits in here, because it wasn't exactly clean what was happening here, because we'd already seen the commodities going up. So we knew that there was a possible problem here for equities. That's why you book some of your money here. When we see that increase in speed there, you'd have just put maybe a second buy stop in here just to get off the trade, because if the price goes above that volume and the speed, highly likely we're coming back up to retest the highs again, and you can start watching for another opportunity to go again into the short trade. So when we look at these overall pictures, order flow trading is way beyond just order flow trading, isn't it? It's not the same as everybody else's order flow trading, where they look at exhaustions and absorptions and that's it. That's the extent of it. Or they look at deltas, or they look at the footprint chart, or they look at order flow and the profile chart. That's where the trade stops. That's where their setup stops. And that's why people can't, whilst it's good education, people can't turn it into a consistent winning idea. And obviously that's different because we're trying to tie these elements together to give you the best, highest probability trade that you can possibly have on the screens at any one time. And if it's not clear, you're going to start to get a good idea that it's not clear, because all the setups are not equal. Sometimes you're going to get a top edge that looks on the face of it to be a great top edge and it's not, and you walk away. Sometimes you're going to get a top edge that looks on the face of it to be pretty grubby. I don't know, I'm not sure, but all the lines line up and you say it's got to be a sell trade, it's got to be a buy trade. What's going to happen with your trading, I hope, is that through practice you're going to start being able to differentiate between the good and the bad. You're going to be able to start seeing which ones are really good, because you're going to have a tick list of working your way through. I've got a level 2 seller behind me. I've got a seller's auction behind me. I've got a divergent value behind me. I've got short-term value against me just now, so I just have to be careful and wait for that to turn off. I've got a bearish market maker. Perfect. We've already gained the big liquidity. We've already done blah, blah, blah. I've already checked the big picture. I've already made sure that the macro sellers are interested in this. I think I'm pretty safe. I'm going to take a sell trade. The first sign I get a top edge, the first sign I get of a big volume getting trapped, the first sign I see of a speed increase, for example, I'm going to take that and I'm going to pop into that as a sell trade. I'm going to try and get some business off it. And guess what? Sometimes you don't get any business. Sometimes you end up walking away and say, okay, well, I never did any business on that. When I was disappointed, I thought I might get some action on it. And you walk away from the trade and you wait for the next opportunity. The ability to make that choice, the ability to differentiate between the good trades and the rank trades is going to start making the difference between you as a trader. Being able to avoid the rubbish and being able to pick up on the very good is going to mark you up as a professional trader. Instead of taking trades everywhere, you don't. We've got a bid on commodities just now, so you're obviously getting a lot of volatility kicking off. You can see there's a lot of things happening just now, but you're getting a strong bid on commodities. Market makers obviously recognized some of that strong bid on commodities and has lifted off the bottom edges a little bit here. So the market maker's obviously a little bit concerned. So if the price then drops down into these areas, if the commodities start seeing that we get a turnaround in the program buyers, there might be an opportunity to maybe be long off the bottom edges here because of that big lift in the commodities here. Because of the big lift in commodities at this point, there might be an opportunity to be a nice cheeky buyer off the bottom edges here. You can see that this has a very, very big downtick in terms of the prem. So that means that the futures market is underpriced against the index, but there's still some sell programs coming in behind this. So you're patient. You haven't seen, we've got some sellers coming in here now, okay? You can see the block sellers coming in. Market makers are still bullish. So you could obviously start to explore these ideas. You need to make sure there's no volume in the sell side, and then you could go for it. Then you could go for it. If you went for it, you could have picked up 95.25. It's just went 96.5. You could have picked up 95.5. It's just went 97s. 6 ticks on the NASDAQ, stops at break even off the bottom. It's enough to take a little swing at the trade. It's enough to take a little swing at the trade. You're trading against the sell programs, but you've taken a pop at it. It's now at 97 3/4 there, dropped back down to 96.5. Your stops are obviously at break even anyway. And obviously you're going to start working this idea now. You're starting to work this level. So when you can understand that, there's no reason why you shouldn't have taken a pop at some buys on that volume that got trapped there. And you would have made 6 ticks. You could have made 6 ticks. And even if that meant that you could have put a stop at -5 ticks, you still pick up a tick on profit if the market goes against you, but it buys you time at the bottom edge just to see what happens. If you picked up 10 ticks, you could put a stop at -9 on your second contract, and that way you're still going to make 1 tick if the price then breaks south, aren't you? You're still going to make 1 tick profit. So there's a lot of different ways to explore this. Instead of just getting stopped out at break even +1 and the rest and then having to find a way back in, you could easily have taken 6 ticks and then put a stop at -5. And that way you're still in this buy trade, which is now exploding to the upside here on the back of the bid that was coming in the commodity risk line. So that trapped volume there, the market maker was bullish on this downtick. The auction had gone bullish on a downtick. In other words, we'd moved into a buyer's auction. The commodity line had gone bullish on this downtick. The Prem had gone bullish on this downtick. There was still some sell programs coming in the background. And that's unlucky, because otherwise we'd have had a full clean sweep of everything in the right place for that buy trade right there. Everything would have been perfect for that buy trade. As it turns out, we had most lines in favor, and therefore you would have taken a small buy trade and to explore this level. You've got the right setup, you've got the right scenario, you've got the right little volume at the bottom, and there's the takeaway. There's the takeaway, a very, very sensible little bottom edge buy trade, which has ended up going from 95.5 up to 76.01. And we just talked that trade through in real time. We just talked about that trade in real time. You know, the question the other day was about seeing it on the right-hand edge. We just talked about that trade as it was developing. I says you're going to be watching for this buy trade. The market maker is not bearish, they're bullish. We saw that volume in real time. We saw this uptick on the commodities in real time. We told you in real time that the futures market was now cheap. So you're going to be watching that and saying, I could have put a buy stop order there, no problem. And you would have got taken into a very nice winning buy trade on the right-hand edge of your charts, guys. Oil, by the way, just came off that $62.80 level. Can't make it up. Remember that level from yesterday? Having got a level 2 bottom edge buy trade off that last 62.60 level. Got a level 2 buyer came in off of 40. And obviously we squeezed through the 62.80 where the selling came straight back in again. So what other things can we see? Well, let's take a look at gold. I wanted to highlight a couple. So what other things can we see? Well, let's take a look at gold. I wanted to highlight a couple of gold trades that we saw on the charts earlier. The line I want to pay attention to is well, we've obviously got this big shaded area at the top edge. The market maker is the dotted line again. The market maker is the dotted line. The buyers and sellers auction is this thin blue line. I want you to focus on these two lines because they're really, really important. Okay, really important lines. The blue line, the thin blue line, and the orange dotted line. Hopefully you can see it. As the price rallies here, you can see the market maker goes bearish. The auction starts to reverse round. We start seeing an increase in the speed of price activity at that high, which means that there are some algorithms taking place in this market. If you understand, guys, that the market maker these days is predominantly an algorithm. It's not some guy offering up opportunities to buy and sell the spreads. It's not some guy with firing in a couple of hand signals. The market maker is predominantly an an automated program these days reading the order flow as it happens. And when we see an increase in speed, when the market maker goes offered here, I'm thinking sell straight away. It goes into a seller's auction, the blue line drops, and then the price drops beautifully off that level. It happens again here. The price goes up, the market maker goes down. We get another increase in speed, and within a few seconds, the price drops again down into the bottom edge. But what I want you to recognize is this top edge here. What I want you to recognize is this top edge here. The market maker goes offered as the price rallies. Take a look at the little blue square. See it? What is that? Blocked buyers. That's trapped buyers right there. That's a buyer that's crossed the spread at the top tick price. It doesn't just happen to you guys. It happens to everybody. Somebody's bought the top tick price right there, that blue box. The market maker has gone sell side. The blue line drops, which puts us into a seller's auction. The speed increases again as the market maker goes bearish in exactly the same price as they did exactly the same thing the last time. You see it? See the little voltic? And look at these two voltics right here. Exactly the same price. Identical prices for the voltic, guys. With the market maker going offered, these voltics are more than likely, you can't be 100% certain, you never can, but these voltics are more than likely to be the market makers getting rid of inventory off the top edge. And obviously, if they're getting rid of inventory off the top edge because they don't detect anything toxic about that top edge at all, well, so should you. You should put a little sell stop order in this direction and get the trade on. You should put another sell stop order in this direction, get the trade on. You've got confluence, you've got confirmation, you've got order flow coming out your ears, and all you need to do is execute on those two trades. And they're not big trades, guys. This is a 200 volume chart on gold. This is a 200 volume chart on gold. It's not a tick chart. It's not a minute chart. It's not a time-based chart. It's volume-based because we're trying to take volume out of this analysis. That's why they're not volume candles, because every candle is 200 volume. So you can obviously see you could have taken a little sell and a nice profit. Over $100 of profit on that trade. That took 15 minutes. And then you could have taken a sell here at 95s, traded a low print price at 92.5, so that's a $250 profit. And that period of time was about an hour. So you've maybe done around about $350 on a single contract, just using some of that key information. Some of that key information. So when we look for this key information, we're always reading. We're always reading. Look at this absorption box, for example. See that? Look at the divergence in the volume. Look at the market maker turning back bullish right there. We don't get a speed increase down here, but we certainly have a book balance imbalance coming in here. Look. See these blue dashes? So when the market maker goes bidding, we get blue dashes. That means that not only is the market maker bullish, but the order flow's just gone bullish as well. And you can see that the price rallies off that level for $100. Nice and sharp, nice and easy. So when you see that, look at that trade. Look, I mean, when I say the $100, actually make that $200 by the time we reach up the top edge here. Combining information, and you're going to look at a chart a lot of the times. There's a buy trade. Look at that buy trade right there, guys. See it? The market makers went very bullish just there. The price downticks. The speed increases at 93.2. Within the next candle, it's trading at 94. $80 profit in one single candle break to the upside. And it carried on a little bit. Bearish off the top edge, bullish, scratch trade, whatever. So it is possible. There was another buy trade there using order flow. There was a buy trade there using order flow. Buy trade there, buy trade there. This wasn't a sell trade because obviously you'd have wanted it to go back up and do exactly the same with the market maker. So that couldn't have been a sell trade. So just using order flow, already you're starting to see some incredible trading opportunities. And when you're combining the order flow plus some of these other elements, I'm watching this bearish order flow just now. I'm not looking at anything that looks particularly appealing. I still don't see anything that looks appealing. I would have liked to have seen a speed increase down here, but it didn't happen. Some toxic order flow coming in behind and it's still dropping. Market makers diverging off the bottom edges here, see that? The volume is still bearish, so you need to see that volume lifting, which it does. There's a buy trade. There's a buy trade. And that buy trade actually does okay. It comes off the bottom edge quite nicely, doesn't it? Comes off the bottom edge quite nicely. You can see there's a possible sell trade in here, where the blue line starts to drop. You then get that increase. The market maker is definitely bearish into that price level there. You can see what happens. The price then drops back off of that price print, doesn't it? Market maker is still neutral as we come back into this same level as we dealt before. The volume goes bullish. The speed increases. There's a buy trade. There's your outcome. You see it? I mean, I'm not seeing something that you guys couldn't see. What I'm showing you is a speed increase, a divergent market maker, a buyer's auction, which is the blue line rising, and then a trade and an outcome. I'm seeing a bearish market maker. I'm seeing a seller's auction, blue line dropping. I'm seeing an increase in speed and a sell trade, and there's the outcome. I'm seeing a bullish market maker here. I'm seeing a downtick in price. I'm seeing a reversal in the buyer's auction, and there's the speed increase, and there's your buy trade, and there's your outcome. Every single one of these trades has made hundreds of dollars on a single contract. There hasn't been any trade yet that's had any more than a 1 or 2 tick drawdown just yet on using order flow. And there might be, so we're trying to find that combination. How good did this buy trade do now, guys? It's just went from 91s to a high print price of 96.8. I mean, that's maybe a $500 profit if you were able to hold in long enough. There certainly wasn't any order flow to tell you to get sell side out of this area. So you'd have been able to hold into a very, very nice, impressive trade here, but we can see a speed increase here. Now, the market maker is obviously just starting to kick off in the US session here. And obviously, we've obviously lost connection at that point, so I don't know what happened there. Oh, that was the non-farm payroll, so that's all right. That's the market maker is just going to go flat at that stage. That's why the orange line goes flat as well, because the market maker is not doing any business. Here's a great selling opportunity this afternoon. Look, we've got the bearish market maker. We're in a buyer's auction, so we can't do the trade. We drop into a seller's auction here. We get the speed increase there. There's your sell trade. There's your outcome. Got it? Absolutely. Absolutely. Still looking, still looking, still looking for another opportunity. Don't see any more. So that would have been a good little trade, wouldn't it? Very nice. So we're trying to combine pieces of information. We're trying to combine them, trying to find, you might say, what about these? Why were these not sell trades? Because you've got a bearish market maker. You had a speed increase. Why is that not a sell trade that gets stopped out? Because you were still in a buyer's auction. Look at the blue line. It didn't turn into a seller's auction until over here. I don't want to sell into a buyer's auction. I want to sell into a seller's auction, because a buyer's auction means that you're the guy that's going to be standing in front of volume. Do you want to be the guy that stands in front of buy volume? Don't think so. Don't think so. So when we're looking at this, we can start making sensible decisions, not just rash decisions about things that are happening at different points in the screens. We can wait. We've got the ability to be patient. Why is that not a buy trade when the market maker's diverging? We're in a seller's auction. So if I could get a downtick after that, I would be interested. We didn't get a downtick after it. I'm not interested. Why is this not a sell trade? The market maker's bearish. Because we're in a buyer's auction. I'm not going to stand in front of it. It does drop, but I'm not going to stand in front of it. You might decide to sell it here, because obviously the market moves into a seller's auction at that stage. You know what I mean? It's not about all the trades. It's about picking and choosing the good trades, finding great opportunities. Look at this opportunity here. Do you see the little ICE indicator below the chart here? You might not be able to see it, but just in this little blue circle, do you see the word ICE? If you see the word ICE, what is the market maker doing at that point? What is the market maker doing at that point? Are they bullish or bearish on the downtick? Make a read. Are they bullish or bearish on the downtick? Make a read. Bullish. What kind of auction are we in? Are we in a buyer's auction or a seller's auction on a downtick? Are we in a buyer's auction or a seller's auction based on the light blue line? We're in a buyer's auction. The light blue line is rising. So that means that we're in a buyer's auction. That means there's no volume on a downtick. Agreed? There's no volume on a downtick. Nobody is selling, in other words. If nobody's selling and then somebody decides to ICE all the orders because nobody's selling and somebody steps into the market, I know it's not a speed increase, but you would start to look at that and say, well, nobody's selling this. The market maker's bullish. Somebody's ICing 92.8. What the hell? I'm going to take a pop at some buy-side trade right there. I'm going to take a pop at this. And there's your profit. 92.8 trades 93.7. You've made $100 inside of a couple of minutes. You're waiting for the next trade. Well, that buy turned out a lot better, didn't it? Traded all the way up to 94.2, 140 bucks, for God's sake. Well, that was pretty good. But do you see how you're able to rattle through a chart and see these things as they're happening? You can see all the good stuff. Not in hindsight, because you're trying to combine pieces of information. You're trying to find pieces of information that confirm each other. And I'm not using the thick blue line or the green line on this. I'm not using toxic order flow. I'm trying to guess where the toxic order flow is without using the toxic order flow indicator, because this isn't ready yet for distribution. We're still testing it. Now I can see something happening up here. Does everybody see some sort of activity up here? Do you see the ICE order? Do you see the activity? Look, the three balls in a row here. See it? Voltic, Voltic, Voltic. What's the market maker doing at this price? Are they bullish or bearish? Neutral. Neutral to bearish. Neutral to bearish because we came off a high here. They've dropped down. The prices went higher. They haven't gone up with the price, so they're probably bearish on an uptick, yeah? So we would say that they're neutral to bearish. What kind of auction are we in? A buyer's or a seller's auction. Blue line is dropping, so we move into a seller's auction. That means there's no volume on the buy side of the book. That means there's no volume on the buy side of the book. Well, if there's no volume on the buy side of the book and somebody ICEs the top edge, is that not a great signal for a quick pop at some short business up here? What do you think? Is it not worth a while taking a pop at it, see what happens? Yeah, what happens? It just sells off 95.2, trades down to 94.3, another $90 profit inside of a couple of minutes. And it's not even a couple of minutes, it's under a minute. You've just made 90 bucks. Do it, Tim, do it, do it, do it, do it. It's a beauty. Now we don't like the market maker because they've decided that it's gone bullish at that point. You're obviously just going to take that and say, I'm going to take my first contract off in here. Market maker's gone bullish. We're still in a seller's auction, but you know what? I'm just going to take some profits. and I'm going to put some of that and put my stops at break even, and I'll buy myself time to see if the market maker decides against this trade. And obviously you can buy yourself time. As it turns out, the market maker's bullishness was absolutely correct. We moved into a buyer's auction, which meant you would have got scratched out anyway. And that's okay, because at least you would have been able to read that in real time on the right-hand edge of the chart. Can you trade right off this screen? Yes, you can if you're an order flow trader. If you're an order flow trader, you can trade this right off this chart. I mean, this has trade buy boxes and sell boxes. Sierra Charts has a chart trade package, which is part of the normal package. You can just turn it into a chart trader where you can put buy limits on the screens. You can move your buy limits around. You can do the same ATM type strategies that you can do a Ninja Trader, and you can trade straight off the chart, We've showed a couple of trades actually straight off the chart on many occasions. We sometimes put the interns on this chart so that we can show people the actual trades that the interns are taking, and we can show the lines, we can move the stops about, we can talk about those trades, we can show them as they happen, and so on and so forth. But, you know, so we do use this. We actually use this for the interns. What are you thinking, guys? What are you thinking now? Well, you can see, of course, that there's a nice order here. The market maker's gone bearish. There's a nice order here. The market maker's gone bearish. You can see here that the books moved into a seller's auction. That could be a good sell trade there, couldn't it? It's not ideal, but it could be a good sell trade. Price drops. Price drops. Neutral. ICE order at the top edge, but the market's gone bullish here, so I'm not going to be taking that trade. Might be good, but it turns out it's not good. See how the market maker went bullish at that point? Market maker's gone bullish. Book's gone a little bit too bullish. Price goes higher. So you'd have been safe on that one. Trapped buyer at the top edge, but the market maker's bullish, so I'm not really that bothered about it. Price goes higher, so you wouldn't have got stopped out. Trapped buyer at the top edge, the market maker's neutral, the book's gone bearish. So guess what? That's a sell trade. Trapped buyer at the top edge. Market maker's neutral, they're not going up. The auction is now sell side. It's a seller's auction on a top edge. You've got to be damn tootin' right. We're going to be bearish at that one. What happens next? The price drops enough. Possibly scratch at break even. Possibly. Definitely now a scratch at break even. See it? But you'll see the advantage. See the green line going very bullish there? This is the line that's being tested just now, because this is what we're using as our toxic order flow indicator. This green line and the purple line is based on a little bit of simple research. It's called the VPIN line, and it's based on some academic research in the background. It's based on some academic research that the regulators did into the flash crash. So the regulators did some research into the flash crash, and they were able to identify the main reason for the flash crash. And we did this in the webinar, actually. You may recall it. And obviously, based on that information, there were some academic research units that started to look at the information that the regulators had generated, and obviously started to model the flash crash and to try and identify toxic order flow. And we've taken a very rough and ready version of that academic research, and we've converted it into this green line, purple line. So obviously when we see toxic order flow, it'll show up as a green line moving higher or a purple line moving higher, and we're looking at the various different ideas on this. And obviously you can see both of them are moving higher. So we've detected some toxic buyers at the top edge here, even though the market maker hasn't, even though the order flow hasn't, we have, okay? And obviously in that type of environment, this would negate me taking a short trade off the top edge for the time being, just because I've detected some toxic buyers, even though the market maker hasn't, and even though the order flow hasn't, we have, and that's why the green line's rising. And as a result, the price rises. Now this line is under test at the moment. It's not in the package, but this is what's being tested. And obviously that would have saved you test at the moment. It's not in the package, but this is what's being tested. And obviously that would have saved you selling into the top and then getting stopped out on the break higher. Okay. This was the volume in the article. This is the article I showed Tim on the this was the article we showed in the webinar when we were talking about the SEC that most people probably just glazed over and never bothered listening to me. But instead of that, what we're doing in the background is we're taking that type of information and trying to convert it into something that you guys can use. That's our commitment to a professional trade room. Not a rehash of somebody else, but to actually taking academic research, getting it programmed up, checking it, testing it, seeing if it works for us, seeing if the data is clean enough to use it, and then display it on the charts, the green line and the purple line. The green line and the purple line, and look at what happened to that trade. It went ballistic to the upside. You see it? So we would have saved the market maker a fortune on that trade, wouldn't we? We would have saved the market maker a fortune on that trade. Market maker still bearish. Green line levels out. Volume drops on an uptick. Purple line's dropping. Green line's flat. Sell trade. Ice order, what do you think? Yeah, got to be, hasn't it? It's got to be at least a try at it. It's got to be at least a try at it. What happens next? The price drops off quite nicely. It goes from 96.4 to 95.7. We pick up $70. Stops at break even, yeah? Stops at break even. Well, look at what just happened, guys. Unbelievable. Unbelievable. We've now got a top edge. We've now got a top edge. The price has now dropped off. We've made another $100 of profit. We've just got the perfect little cheeky top edge order flow sell. When these lines all stack up, and I'm talking about getting the market makers in place, we're not getting a negative on the green line, purple line. The market moves into a seller's auction. The algorithms appear on the charts as if by magic, the Baltic. Then you really don't have anything in the world that's going to be better than that. This is the screenseer reading that order flow. None of these lines are laggards. None of them are going to be price action based lagging indicators. They're real-time decision systems. They're the kind of systems that the banks use inside of the world of their HFTs, inside the world of their algorithms. And therefore, the algorithms are doing these calculations all the time, trying to find the best opportunities. And then when they see an opportunity, you'll either start seeing this kind of ice order appearing, or you'll see this increase in speed, or you'll see a block trade getting absorbed, or you'll see one of these types of signals that allows you to make a decision that then makes instant money, because you're trading the same way as us, that you're trading the same way as the big banks are starting to trade. It doesn't mean it's a big swing trade. It's an order flow trade. You don't know if there's any sell value in this. There might be tons of buy value, but you still end up making a profit on the algorithm trade. Here's a really interesting trade. We've got one concern, this uptick here. But this looks like a really interesting trade. The volume is now going bearish. The market maker's still pretty neutral. You might take a small pop at this, see what happens. Nothing happens. It ices the top edge. It still ices the top edge. As I said, it's just a small trade because this was worrying me a lot. I don't want to trade against this, guys. I don't want to trade against the green line, purple line. If I ever trade against them, what we normally find is that they are right. That's why we're so excited about these two lines. So whilst the market maker looked as if the market maker was neutral, and whilst we'd moved into a seller's auction, whilst we had algorithms kicking off to the upside, my big concern was that we had got toxic buyers on the book at that stage, and therefore I'd have been very reluctant to trade into that, and therefore these are very useful pieces of information. And therefore, if you did take a sell trade, you would have got stopped out for a loss of maybe 1 or 2 ticks, but you'd have taken a very small trade because there was toxic buyers on the book at that stage. And you can see, obviously, the market maker got it wrong because the market maker immediately adjusts their book to the upside. So the market maker realizes they got that trade wrong. Well, No shit, Sherlock, they got the trade wrong. But if they just bought our algorithm here, we were already bullish before the market maker got their trade wrong. So they could obviously see that developing story. Now they're going to go again here, look. But look at the difference in the purple line. See it? See the difference this time? Market maker's gone a little bit bearish. The order flow has now gone into a seller's auction. We're now getting no toxic buyers at the top edge. We get a speed increase there. And if we just take a little sell below that speed increase, we would put a sell stop order in at 97.2. And you can see that we get a very nice sell side response on that. We get some very toxic selling order flow coming in here. And look at that trade, guys. Look at that trade now. 97.2 sell side opportunity. All the lines were in our favor. You see it? You see it? I mean, I'll take you back to the decision so you can actually be 100% clear that that would have been a decision that you could have made on the right-hand edge. There's the candle on the right-hand edge. It's a green up candle into a top edge. Green up candle. The market maker has gone bearish. Very small bearish, but bearish. Our toxic order flow has gone bearish. Our green line is neutral, it's flat. The macro is bearish in the background, but it is flat. The order flow has gone bearish. So in other words, we've just moved into a seller's auction. And then we get the algorithms firing off again right here. This was no use to us because it was in a buyer's auction, so this was too soon as well. But we get the market maker's algorithms firing off at that point with all of these lines either pointing down or flat. All of them pointing down or flat. And obviously what happens is we get that brilliant sell away from that level. Look at it. And then all of a sudden the toxic order flow says, what the hell is even that? Somebody stepped into this market and started smacking some orders about. And obviously the price then sells off like an absolute choo-choo train after that, doesn't it look? You see it? There was your trade right there, guys. There was your trade. 97.2, 95.6. The trade lasted 3 minutes. That trade there was 3 minutes. $170. $170 in 3 minutes, guys. You don't need that many of those trades each day to be a very, very, very successful trader. And yes, if you took this trade, you got stopped out for a loss of maybe 1 or 2 ticks, but you were already getting some warning signs about that. Even this market maker going bullish would still have stopped you out for a loss of like 2 ticks, guys. 2 ticks. You're going to still have losses when you're an order flow trader, but your losses are going to be like 1s, 2s, 3 tick losses on those trades. You don't hang about. If you've got it wrong, you've got it wrong. Get off the trade. When you've got it right and you catch a seller's auction like this, stay on it, 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 get off it. There is a buyer's auction, bottom edge, get off it. That's your order flow trade finished. Get off. Profits in the bank account. 3 minutes later, guys, 3 minutes later. So we're really looking and watching for an awful lot of stuff that's going on in the background here. But as an order flow trader, you have become the guy that's in the pit. You're watching for people absorbing. You're watching for ICE orders. You're watching for somebody that's flashing up 50 sells. And somebody buys that. Somebody flashes up 50 sells. Somebody buys it. Somebody crosses the spread into that 50 and somebody takes it. And you're saying, okay, what's going to happen next? And somebody crosses the spread again and buys 50 and somebody immediately flashes up 50, they'll take it. And the deal's done again. And you're saying, what the hell is this guy doing? And somebody goes again and flashes up 100 and somebody takes it immediately. Toxic selling order flow, isn't it? Toxic selling order flow. Somebody's absorbing all that buying and reloading the book. And the job of the market maker is to see that toxicity early enough that they don't get burnt. They got burnt on this trade because they didn't see the toxicity that we saw. And the market maker lost maybe 2 ticks on that because they then put the price up on these upticks. So the market maker ended up getting that one wrong. Our algorithm got it right. Our algorithm got it right. You can see this order flow here. Look, you see it? You see what I'm looking at? I don't see any ICE orders. I don't see any, obviously, speed tick increases. I do see a change in the order book. See the blue dash line? The market maker's gone bullish. The green line's gone bullish. The purple line's gone bullish. So there's going to be a possible buy trade in there. Just managed to swing for over $100 almost instantly. Almost instantly. Putting these pieces of a jigsaw puzzle together, guys, is incredible. You're not going to see trades on every tick, on every swing, on every piece of information. But as an order flow scalper, your job is to try and make sense of the best of the opportunities. I'll take this along so that it rescales here. You could be looking at this ICE order at the top and saying, should I sell it? But you're in a buyer's auction, so it's a risky sell, isn't it? It's a really risky sell. Should I sell it? Maybe I can find something better. I'll just patiently wait. Thank you very much. And it drops and you get a little bit frustrated. You see the market speed increase here, but the market makers are now bearish. You're now in a seller's auction. You've got toxic selling coming in behind you. So you're maybe going to pass on that as well. And you say, no, it's not good enough. I'm just going to wait. You can see it does go up by a couple of ticks, comes back and scratches you anyway. When you're looking at these, it's not about trading every swing. It's not about selling here and buying here and selling here and buying here. It's about selling good stuff. It's about buying good stuff. It's about buying good levels or buying good explosive opportunities. Could this have been a sell trade? Well, we don't see it in real time because obviously it came down from here, but it could have been, but we can't confirm that it was because we don't see what was happening in real time at that stage because the candle closes at the lows. But what I do see is I see an exhaustion print behind this ICE order right here. That's a reloaded order book right there. If you see somebody icing an order level here, and then it exhausts here, and then it breaks back below, that's a refreshed order book, isn't it? You can see that the toxic order flow goes bearish. The market maker goes bearish. The book goes bearish. So if you could have got a price up here, and I don't know whether you did, but that would have been an opportunity to take a quick scalp trade on the sell side. And you can see you would have been able to make yourself maybe 3, 4, 5 ticks on the trade, $50 more, and you're getting ready for your next opportunity because you can see some toxic buyers coming in right there. And as soon as that toxic buyer comes in, look at price rallies. See how the toxic buyer managed to beat the market maker to the trade? Now, it doesn't develop much, but you can see the market maker responds one candle later than our algorithm. So we beat the market maker on that trade, didn't we? Look, our algorithm goes bearish here. Market maker is still bullish. So we beat the market maker to the sell trade again here. The price then drops. The market maker then drops as well. So we're beating the market maker on every one of these swings, aren't we? And this is the right-hand edge at the moment, guys. So we're actually beating the market maker on every one of these swings. Think about the power of that green-purple line. This is one of the things that you'll realize by being involved in this room. This room isn't like the other rooms where they bring out price-derived indicators and they get you to buy into some of these ideas. We're actually on the leading edge of retail space here. You guys are getting information and you're getting to see what the institutions are developing. Now, we've got better data than you guys. We've got data that is a lot cleaner, a lot fresher, a lot faster. It's co-located in most cases, and it's instant. You guys have got a lag of microseconds. But in your world, that doesn't make a lot of difference. In our world, it makes a lot of difference. But what you're seeing on the right-hand edge of this chart is leading edge research. It's based on academic research papers. It's not just based on a lag on a trade, like, you know, a moving average or a rehashed Bollinger Band, for example, or a rehashed stochastic or RSI indicator. It's actual real-time volume, real-time order flow, real-time imbalances, and real-time market maker pricing happening on the right-hand edge. Is it always going to be right? Well, we've just done probably about a couple of dozen trade examples of what you would have seen, and you would have been able to make some decisions that resulted in hundreds and hundreds of dollars of profits, some of which resulted in $50 of profits and stops at break-evens. The point that I'm trying to make is that you're going to watch this on the right-hand edge and you're going to see things. And you're going to try and stack probabilities in your favor. ICE plus divergence plus trap traders plus whatever else suggests that, well, if I see a lot of ICE at the top here, ICE at the top here, ICE at the top here, once I see this toxic order flow coming into the sell side and the market maker drops, the only trade I should be thinking about is maybe a sell trade in here. Reasonable? Is that about reasonable, guys? If you see somebody icing the order flow here, icing the order flow here, icing the order flow here, is it reasonable that if we start seeing some toxic order flow coming in here with the green line, purple line dropping, we're anticipating the market maker starting to sell off? So we can actually beat the market maker to that trade, get in at 96.2, pick up a nice $50 profit, and get a stop at break even, and we're ahead of the market maker by one tick. By one candle, we're ahead of the market maker. What other retail trader in the world is actually ahead of the market maker? Probably none of them. So this is unique in the world of retail trading. Unique. If you honestly could go back to your retail traders and say, I'm trading before the market maker even gets a sniff at this. But once I get the market maker confirming that they're on the same side as me, I'm in great shape. And I can pick up a quick $50, put it in my pocket, wait for the next trade, at least stops at break even, give myself a bit of breathing space. And that's what order flow trading is about. We haven't even looked at value in this chart, have we? We haven't even looked to see whether we want to be sell side on these trades. This is order flow scalping. This isn't swing trading, it's not value trading, it's not commercial trading. This is you becoming the best pit trader that you can possibly be. Pit traders don't swing. Pit traders take a trade, they take profits, they take a trade, they take profits. They don't really care about the big macro. But if you can start putting some big macro information in the background to help you, you can obviously enhance this significantly by putting big trades at the top, small trades at the bottom when you're bearish. When you're bullish, putting some big trades at the bottom and small trades at the top when you're bullish. Because that way you can take advantage of perhaps some developing swings away from these levels. Think about it, guys. Because if you can now beat the market maker, and you now know where the commercials are going to be doing business, you can now beat the commercials because you know what the commercials are going to be doing before the commercials do it. And now you can beat the market makers because you know what the market makers will do because of the toxic order flow that's coming in. So you can beat them. There's no reason why you can't become one of the best traders in the world by doing this. There's no reason. What you've got to do is be able to identify when it is that good to execute. Because there's a lot of noise on this. There's a lot of noise on this chart. There's lines all over the place. What are you not doing right now? You're not selling it, are you? You are not even close to be selling this. Market maker's bullish. Toxic order flow is relatively bullish off the bottom edge. The market auction is bullish. You're not even going to be thinking about taking a sell trade. So you wait, you wait, you wait, you wait, you wait, and you just keep waiting until a trade sets up. Until you can see the change in the auction, until you see a change in some of the order flow signals, you just wait for something to develop, and then you execute. And if you practice this over and over again, and you get yourself maybe 100 hours under your belt in terms of actual over and over again, and you get yourself maybe 100 hours under your belt in terms of actual trade time, scalping away on a demo account, what you should be doing is you should find yourself trading at 85% winners and a nice profit. When you do that, after 100 odd hours of scalping practice, it's time to start trading some live money on whatever account you're trading. It's time to put it into practice. Small size, ones and twos, trying to capture some of these trades. And if you can replicate your demo trading, start going up to twos and threes. Once your account's growing, start reducing the amount of total risk and start bringing the risk down to 1% or 0.5% per trade. You're now trading fives. Then you're trading sevens, and then you're trading 10 lots. And all of a sudden, every single good trade's a 10 lot, and every single average trade's a 5 lot. And you're taking it in 2 or 3 individual entries. I'm selling 2, I'm selling 2, I'm selling 2. I'm in great shape, got a great average price. I'm scalping it. Here we go. There's the trade. Boom, 5 ticks, $50 on a 10 lot. I'll take that. It's 500 bucks. And your order flow becomes a book. You become a pit trader, you become a floor trader, and you've got the same type of feedback information that these guys would be seeing through the hand signals. This toxic order flow is the guy's hand signals coming in from this is the institutional toxic order flow. So when the hand signals go bullish, this is Merrill's putting their hand up saying, I'm a buyer. You've got to then decide, well, I'm not going to sell to you. I'm going to wait for your buying to disappear off the book for the time being. Thank you very much. I'm not going to take the other side of it. And that's a great decision for a floor trader, isn't it? You don't want the other side of Merrill's buying. So you take a step back and say, I'm going to wait for Merrill to start selling before I start selling. At the moment, Merrill's are still buying, so you're not going to do anything. The market's moved into a seller's auction. Merrill's are still buying. So you're saying, I'm just going to wait for it. If it drops, it drops. Who cares? I'm not going to take advantage of this until I see something else than this. These guys are still buying. Merrill's are still buying here. There's still a bit of toxic. Market makers are bearish. The book's bearish. So it should have been a sell, but you know what? I'm happy to wait. I'm happy to wait. It might drop for $1,000 and I'll regret it, but I'm happy to wait. I'm happy to see what's going to happen to the upside because I see some toxic buying still coming in, perhaps enough to push the price back up again, and then I can maybe get my entry in place. And look at what just happened, guys. The toxic order flow, the price has came back up. If you'd taken a sell trade, you've just been stopped out at break even. So the toxic order flow got it right. Does it mean that it's going to not be a sell trade? There it's gone up again to the top edge tick. So the toxic order flow beat the market maker by 1 candle. The market maker's gone back up again. We've still got a seller's auction. We want to get short. And now our job is to try and start working some orders and try and start working some order flow now into the top edges. So it's one of those types of trades that you can start to see. I do want to get the trade on, but I just want to be careful with the trade. I don't want to cross the spread. I don't want to pay up. I don't want to be the guy that sells on a downtick. I want to be that passive guy that's just watching from afar to make sure that there's really no more toxicity coming into this price. And once I'm absolutely sure that Merrill's are finished buying, I can step up into an uptick and I can take advantage of that reversal trade and I can sell off the top edge, which looks like a good opportunity. Working the prices on the right-hand edge of your screen becomes your job. You become a floor trader. This is floor trading. This is a pit trade operation here. And look at what's just happened. We just says you start working the order flow. You can see that the toxicity drops here. The market maker drops here. You could have started to work into this 96.7, for example. You know you want to be selling it. Somebody did sell it. It just went 96.7 to 96.2, $50. on the back of the order flow dropping here. You just made 50 bucks working the top edge when you knew that the opportunity was striking. When you started to see this pausing and flopping over, when you saw this pausing and flopping over, you start working those orders on that candle, didn't you? That's what I said, work the orders now, work the orders now. And there's the outcome, $50 inside of about 20 seconds. Do you see it? Does it start to make some sort of sense, guys? I mean, I hope it does, because once you start practicing this process, and it doesn't matter if you've not got David's package, obviously you're not going to have some of these lines, but you'll still see absorptions and exhaustions. You'll still see the book exhausting out on NOFT software or OFA software. You just won't see the dotted lines in fact, you won't see any of these lines on the other software, because none of the other software are institutional. We're institutional. That's why we've got institutional lines on our charts against an order flow software, which is a retail package. Because we're trying to give ourselves the best institutional edge in the world of scalping, in the world of floor trading, in the world of pit trading. We're trying to give ourselves an institutional edge on all of these trades so that we can walk away in the right-hand side with great profitability. So when we see these types of trades developing, we've got to try and start making good decisions on a regular repeat basis. We couldn't be a seller during any of this phase. Market makers bullish, buyer's auction. But as soon as this line starts to drop, you start switching on. Market maker drops. We've still got a bit of toxicity, so we don't just sell it straight away. We wait for that toxicity to come off the trade, and then we sell it. We start working orders. And if we didn't get filled, fair enough. If we did get filled, we would have got filled at 96.7s. And you can see the price then drops to 96.1 and we make $60 of profit inside of that 30-second section. And our stops are at break even again. And it looks quite good actually for a sell at the moment, doesn't it? Your stops at break even off the top edges here. You're obviously in at 96.7. Your stop may be at 96.6 for $10. So you're obviously in that trade there. It looks good to the bearish, looks good to the downside at the moment. So you would have taken one trade off for profit, and you'd have a break at stop at break even at the moment for the second contract. Free trade, take a coffee break, stop staring at the screens, get away for a few minutes. Come back if you're still in the trade, you're in good shape. If you've been stopped out at break even +1, okay, take a break. Go and look at something else, refocus your eyes, get a refresher. Look at value, take a look to see if value is bearish at this point. Reading order flow is just putting as much pieces of information together as you possibly can do to make the best possible decision with the highest probability. If you take rubbish trades, you'll get rubbish results. If you try and sell on this buyer's auction, you'll get pushed over by the buyers. That's why it's called a buyer's auction. This blue line is buyers and sellers auction. I don't ever want to be a buyer if the blue line's going up. I don't ever want to be a seller. Sorry, I don't want ever to be a buyer. I don't ever want to be a seller if the blue line is going up. If the blue line is diverging and it drops down, I could take a possible buy trade. I've got to be careful, but I could take a possible buy trade because of divergence. So obviously we want to make sure we get that divergence on the book and then start working some orders. And when we see all of these things developing and we start seeing these order flow developing stories on the right-hand edge, you can start making some incredible decisions on what ultimately is one of the most advanced retail packages, if not the most advanced retail package in the entire universe of retail trading. It's got to be good, guys. I'm going to wind up at that because obviously we're going to do Saturday class anyway. So I'm going to wind up at that. I'll leave this on the screen for the time being. Hope that was of interest. We've got a class still to finish off when we reconstruct the whole S&P for you. So if you still don't know what the lines are, if you still don't know what the commodity risk lines are, if you still don't know what the red line is, when we look at the buy-sell programs, we will deconstruct and reconstruct all of those lines. We'll put them on the S&P chart. We'll build up the chart from scratch. We'll build in the key levels. We'll put in the floor trader pivot levels. And we'll start looking at some of the trade opportunities that you would have seen on that chart without order flow. And then we'll obviously take a look at the overall shape of the order flow, and you'll be able to take a look and see whether you can see opportunities in terms of some of these ideas. We'll start talking about the toxic idea of how to see toxicity. And obviously toxicity is about absorptions and rejections and refreshed order books and about reloaded order books. And when you see it, you can start to make great order flow decisions on the right-hand edge of your screens. And then it's over to your money management. The second half of tomorrow's classroom is going to be all about just equities. We're going to try and get into just getting a look at a lot of screeners to try and read what unusual option activity means for stocks. And we'll obviously be looking at historical unusual option activity so that you could then see what happened to the stock next, because you need to try and build confidence that you're reading it properly. And obviously on that basis, you should be able to start to build out ideas using any screener that you want to use. And you can start to find nice ways into some great opportunities on some of these stocks. We'll cover the concept again of gamma scalping. We'll look at the concept of long volatility, where we go into a straddle or a strangle, but we go into a long volatility trade. And obviously your ability to then make great trading decisions on equities becomes normal. You'll see some of these trades that we make 6% on a day on, and you'll start to be able to put them into your own portfolio. And if you want to day trade stocks, you can day trade stocks as well. Great stuff. So I'm going to finish off at that, guys. I've had a great week. I've enjoyed it. I hope you have as well. For the guys that have just joined us this week, we've still got Saturday. You've still got the recordings. You can still go back over it. You're obviously delighted if you want to hang about for the next 4 weeks as well, when we go into the gold charts, when we go into the bond charts, when we go into the S&P charts again, when we go into the equity charts, when we go into the soybeans, the agriculturals, when we go into the oil, big contract trade for us in oil, when we go into natural gas, and when we obviously go into the spot forex, then obviously you'll get a good look at all of these other markets in addition to the S&P. And obviously from that point, you can start to see markets that perhaps you've never used before, offering you perhaps opportunities that, again, if the market that you're trading is quiet and there's no opportunities, if you pick up a second market, then you might see some opportunities that really start to make some sense. So enjoy. You can see that gold short trade is still developing. Toxic still selling. It's a buyer's auction, so you're a little bit concerned. Book some profits. But you can see that it's still a sell trade. Toxic still selling. Market maker still selling. Order flow is not with it at the moment. So you take a bit of profit, but it's still a sell trade. There is no buying opportunity. You need to put all of these lines together to have a good opportunity, a good shot at getting a great trade. If you don't use all of the lines, you're going to end up making average decisions. All right, guys, have a good one. Enjoy, and I'll see you guys on Saturday if you decide to come in. You don't have to come in, remember, guys. It's going to be recorded. Kim's going to make sure you've got a copy of that recording if you want to watch equities, if you're doing something on Saturday with your beloved. I fully understand that, but on the basis that I'm single at the moment, I don't have anything to do with any beloved unless it's somebody else's. So I'll just leave it at that, and I'll see you guys tomorrow. In the meantime, have a great weekend. Adios amigos, arrivederci, ciao for now. Candle. Put it this way, what was the market maker getting into? What was the market maker getting into here? The market maker was getting short at a lower price. Why would the market maker get short at a lower price? Why would a market maker ever get short at a lower price? The market maker model is normally getting short at a higher price. Why would the market maker get short at a lower price and offer buyers a better deal? Why would the market maker offer a buyer a better deal on their trade? Why would a market maker get short on a downtick? Anyone? Because they're bearish, okay? Because they're bearish. So what's going to happen to this trade? The price, this is a high probability squeeze of this paycheck liquidity at the bottom edge now, isn't it? High probability squeeze. Perhaps it might take this liquidity here, but it's a high probability squeeze for $100. What happens next? Boom. You see how high probability that was? Now, why was that a high probability trade? Because every time a seller comes in, the market maker was withdrawing their liquidity. So if I look at all the big selling deltas, if I look at all the big deltas on this chart, do you see that the big deltas make the market maker pull their liquidity? Look, market maker pulls their liquidity to the very, very lowest price possible so that they don't get trapped on a trade. Okay? Then they got another big delta and another big down candle so that they don't get trapped on the trade. So when you see this happening, you know that the market maker must have detected commercial selling at these prices up here. You must have detected the selling at these prices, yeah? The market maker must have done that, because otherwise that selling would have been an absolute gift for the market maker to say, give me some. But guess what? This trade started ages ago. This trade started earlier than this. If I go back further, do you see the big selling delta with the big down move in the candle? Look, do you see it? Do you see the big selling delta? You see the big imbalance of sellers coming in here? So there must be a commercial seller here, because why would the market maker withdraw the liquidity so much if they were bullish? The answer is they wouldn't. So they're therefore reading this big delta here, and the market maker's response to that big delta tells me that the market maker is bearish. Or rather, the market maker might not be bearish, but the market is definitely bearish. So it's not about the delta that's important, it's about the reaction to the delta that's important, isn't it? So one of the things we know is that there's a commercial seller up here because the market maker's pulled, and the commercial seller's coming in below $53 barrel oil. So if we know there's a commercial seller coming in below $53, well, we know it's going to go to $52.50, because that's where the next wholesale price level is going to be. So when we see that, we can start selling to try and get $52.50 oil, perhaps even $52 oil, perhaps even $51.50 oil. But we would have to see what happens when we get to those key wholesale price areas where market makers and commercials will both be looking for business. So when we look at this, you can see that that selling does come in. Look at this. Look at the withdrawal of liquidity. Look, small deltas, but the market maker's still pulling it as far and as fast as they possibly can, and they're always loading the volume at the bottom of the candle. That means there's still a lot of commercial selling coming in here, isn't there? There's still, and there she goes, look, boom. A lot of commercial selling still coming in. The market maker is withdrawing liquidity to the bottom of the candle. They must still be bearish. That's why when we go back to something like price action or profile, and we ask the question, what is this candle, bullish or bearish? When we ask the question, what is this candle, if I was to draw a candle from an open, high, low, close situation, is this bullish or bearish? And the candle looks a little bit like this in terms of the profile in the candle looks perhaps a little bit like this. Think about the market maker. Think about the fact that if that's got a heavy sell side delta, all of that volume is here. So the market maker must have been, concerned about that selling to pull the liquidity as low as possible before they start taking some of that selling on the book. And obviously that tells me that the next trade is probably, we've got the taper up here, the next trade is probably still sell side, isn't it? It's probably still sell side, unless they trap that. But if they're going to trap that, what's the candle more likely to look like? Okay, we'll do the same size candle and we'll draw the same profile. Hopefully, knowing what I'm going to be showing you here, we'll draw the same profile in the candle, approximately. Okay, so if the market maker wants to now go bullish, what's the candle going to look like? It's the same profile, it's the same PLC in the middle, same PLC in the middle as this one. Yeah, same, exactly identical, but what's going to be different about this candle here if the market maker is now bullish? Yeah, the price, the close will probably be back up here, won't it? The close will probably be back up here. Because what's going to happen is the market maker is now going to absorb that. The market maker is now long, yeah? Market maker is now long 10, plus 10 for argument's sake. The market maker is also plus 10 on this one. They're also plus 10 on this one. But on this one, they've actually gone bullish, so they've actually managed to rotate the price back up. And if they wanted to come off the trade, they could now come off the trade for a profit at this close. Now, obviously, if they're really bearish, they may well come off the close up here because they've now made a profit. What's going to happen? You'll see a bit of volume coming in here from a short trade because you're now going to see selling coming in here you're going to see selling still coming in here at minus 10. It's not going to show up as minus 10 deltas. It's going to show up as plus 10, isn't it? And that's a minus 10 for the market maker. So you're going to see plus 10 up here. And a lot of the times, if the market maker is now bearish, that price will open here and do that. Do you see it? Do you see it now, guys? Because obviously if that happens, the market maker has obviously detected that there's big commercial selling, but because we've now got a candle here with positive deltas and the market maker's now used that to trap these guys, then what's going to happen next? What's going to happen next, guys? What's going to happen next? The price will probably do that, won't it? Does everybody agree with that? The price will probably do that. So when we look at that candle, here, or this candle here, or this candle here, do you see any of those trades? Do you see any of those trades, guys? If you look at this candle here, do you see that exact trade setting up? Look. Positive deltas, down candle. Positive deltas. I know it's marginal, but it's still green. Positive deltas, down candle. What's going to happen next? The price should sell off. The price sells off. You see it? Positive deltas on a down candle. Why do they keep getting positive deltas on a down candle? Because we've now trapped the volume here and we've now got the profit. Do you see the trapped volume and the profit on each of these trades? Look. So there's all the volume coming in the trap. There's the volume. Yeah, you can see the big volume. But the big volume delta is actually in this candle. But okay, so the big volume, that's about a break-even trade, isn't it? You can see the big volume coming in here. I can't even show you because it's too tight. But anyway, the big volume is around about 84. And as soon as the price does 88s, we get positive deltas. The trap's now set and the price now breaks. When we get positive deltas, the big volume was here. Now they're making a profit here. The trap's now set, but they're still bearish because the candle has gone down on positive deltas. So we're now expecting this market to break lower again. There she goes. There she goes. And then we do exactly the same here. There's the big positive deltas here. There's the market maker's profit. Positive deltas. That's exactly right. Positive deltas on a down candle. That's correct. So we're now expecting this market to break lower again. Boom. There she goes. You see it? Well, think about this, guys. If you traded each of those auctions before she goes and used the market maker's process to try and trade those as momentum-based trades based below the 50 line, then your first trade would have been a short trade here at 52.80. That would have been your first short trade at 52.80. Your exit would have been on the volume break back to the upside, which would have been around about 52.70. Okay, so that's a plus 10 ticks on that trade. Your next short trade would have been when you saw this positive delta on this down candle with the volume above, so you'd have sold probably about 70, 52.69.70s, 52.69.70s. Your next exit was this volume break back to the upside at 52.50. That's plus 20. Well, that's $300 on a single contract. That's $300 on a single contract on two trades, which lasted from 12:40 to 12:59, so about 20 minutes of very, very simple order flow trading to make $300 profit. 20 minutes to make $300 profit during that little process of price manipulation. Because the market maker must still be really worried if they keep pulling the liquidity out to get as low a price as possible. They're obviously not worried as much at this price because they obviously reckon what? The market maker obviously reckons what at this price? That they can make a profit, don't they? And it's not going to take much for the price to rotate back up for the market maker to make a profit on that very large buy trade that they now have on their books. It's only going to take maybe 2 or 3 ticks above that volume for the market maker to make a profit because they got so much volume in this trade here. They get so much volume around about 52.40, but if price trades about 52.40, 1s, 42s, 43s, the market maker will make a killing on that trade. But if they're still bearish, they'll take whatever stops that fall out of the book at that stage to get short again. So you'd be looking for exactly the same type of setups in here, and you can see that they are still bearish because they don't get any net positive deltas, but they certainly don't get any strong move above that. You can see there's a block trade 1 tick above the volume, so you can see that probably that block trade was a market maker getting off that, or getting off some of that trade for a profit of maybe 1 tick. And the price trades away from it again off the block volume, and down she goes again. We're now trading at 52.10s. We started this selling trade, guys, at 52.80s. So imagine you still had a 1 lot left over from your first sell and a 1 lot left over from your second sell. You haven't added to this trade because you didn't get the green deltas on a down candle to get more sells. You're now trading 52.10s. You're now trading 52.10s. You've just made another $700 on one contract, another $600 on the other contract on a 2 lot. So all of a sudden that $300 profit is now sitting at $1,600 profit on a 2 lot scalping the oil. And the time period has now went from 12:40 to 13:06. You've now traded 25 minutes. 25 minutes scalping order flow as a momentum trader based simply on order flow. You've made $1,600 profit on a 2 lot. Well, some of you might have been sitting yesterday in awe at the interns. Some of you might have been sitting open mouth at the interns, maybe not in awe, but because you shouldn't be in awe of that situation. But what I'm saying is, a lot of you might be looking at, for example, a profit of $100,000 and saying to yourself, how's it possible? How is it possible to make $100,000 in the market by just scalping? I've just showed you that over a 20-minute period here, $1,600 of profits on a 2 lot. Well, imagine instead of a 2 lot, you're trading a 50 lot, 25 times bigger than that. 25 times $1,600, let's say $2,000, is $50,000 for a small bank desk trader. 50 grand. Yes, it's a good move. I know it's a good move. I'm not arguing that it's a terrible tiny range and all that kind of stuff. But the point is, that when the market does break for you, and you can see the market maker's rotations in the market maker auction, the one thing you've got to try and understand is, well, that makes perfect sense. That's a winning trade for me. I can make money on that information, so long as I just work it, so long as I get a basic idea. So you can just step into the next trade. You can wait for the next opportunity. You can see the market maker starts to withdraw liquidity on this trade now. Look. The market maker starts to withdraw liquidity on this trade because look at what's happening during this process. You've got a tiny little red delta here on an up candle. So the market maker's getting long at higher prices. Price goes up. See it? Do you see how the market, just reading that market maker position allowed you to see that there was a bottom edge definitely getting put in here, because when we saw that red delta on this candle here, and it was an up candle, you'd have probably have looked at it and says, well, wait a minute, something's changed here. The market maker has gone bullish at a higher price. Because remember, the market maker is the opposite of the delta. So if the delta is red, the market maker is bullish at a higher price. That's not normal. If the market maker was still really concerned about price moving lower, why would they go bullish at a higher price? Because they're not bearish anymore, are they? They're not bearish. So you're starting to think this looks like a bottom edge, and I know where it is. I know where the volume is. So I know that this is probably maybe a short-term bottom edge. It might only last one candle, but as a scalper, I don't really care. I can take advantage of that tiny piece of information, step right into that position, and make myself another $300 on the way back off the bottom edge. Imagine a 20 lot on that $300 trade. Another $6,000 towards your $100,000 target per day for your institutional scalpers. And they're only using between 20, I mean, they have gone up to 50 lots in the past, guys, 50 lots. But on average, their trade size is between 10 and 20. You've seen some trades going off with ones and threes. So they don't always get into the 20s on these trades. They sometimes end up with ones and twos and three lots, and they make small amounts, and then they just wait for the next opportunity to get a bit more size into the play. And this is what you're trying to figure out. You're trying to figure this out. Look, now you can see what happens here. Something changes here. Look, a green candle, red deltas. So you're thinking, okay, well, they're still involved in this. They're still taking long trades, but they're now taking long trades down at maybe around about 30. So I'm thinking we're probably going up one, because there was a little bit of selling coming off of this one, tiny amount of selling, but the market maker did withdraw quite a sizable amount of liquidity to drop the price down. So there's a concern at the moment for a possible short. But you can see that little buy trade here, tiny little buy trade, just went from 30 to 37s, $70, $70, and it took absolutely no time at all. Look, it went from 13.28 to 13.30. Took 2 minutes, $70, market maker trade, perfection. Didn't do any more than that, because you can see the market maker takes the opposite view. You can see we've got a green delta on a red candle. What does that tell you? That tells you the market maker is going short at a lower price. Why would the market maker ever go short at a lower price? Because they're obviously now bearish off of that volume there, aren't they, at 35? They're bearish off the volume at 35. So if you were trading that, you would put a sell stop order in at 34, 33. What happens next? Do you see it? Seriously, do you see it? I can't make these trades up, guys, because they're on your screens. They're on your screens in front of you. So you can see that 35 short trade just traded 15s. You just made $200 maybe on a 50 lot. That's another 10 grand to the market maker's pot, isn't it? That's how you can end up with $100,000 on a single day's trading based on a 20 lot. 100 grand a day, $500,000 a week based on a 20 lot. 50 grand a week based on a 2 lot. On that bar, I don't see why the market maker went short, because you've got green deltas. You've just got I mean, I know it's a tiny green delta, but we've got to use something. And all we're doing is just using the color. If it's a green delta, the market maker must have went short, agreed? Because the market maker doesn't cross the spread. So if the delta is positive, it must mean there was more buy market orders. And if it's a red candle, it must have been at a lower price. The close must have been lower than the open for it to be a red candle. The close must be lower than the open to be a red candle. So the simple narrative is that the market maker went short on a down candle. If the simple narrative is that the market maker went short on a down candle, what the hell are they up to? Why are they offering the buyers a good price? Because the buyers got a lower price for their buy trade, didn't they? If the buyer if the initial price on this candle was 35, and the buyer came in and bought one, and the buyer came in and bought a second contract and they got 34, the buyers got a lower price. The deltas are positive, but the buyer got a lower price. Why did they give the buyer a lower price? Because they're just about to screw the buyer. Agreed? Why would you give a buyer a lower price? Buy some more. Buy some more. We're averaging in. Get some more business done. I'm giving you 2 ticks better than you got the last time, and somebody goes, 2 ticks better? I'm going to buy 2 lots this time. I'm going to buy 2 lots this time. I'm going to get a total of 3. I've got a better price. I'm going to increase the size of my trade. I'm finally going to win this one. And then the very next candle, boom. They've just been screwed again. They've just been screwed. Market maker got them. So when you see these manipulation candles, you should be paying attention to them. These are all manipulation candles, these ones here. These are all manipulations. So this is a manipulation candle here. So when you see the delta going in the opposite, this was a manipulation candle here. This wasn't, this wasn't, this wasn't, this wasn't. This was a manipulation candle here. This was a manipulation candle here. This wasn't. And what you've got to try and do is figure out what you're going to do on these manipulation candles. What you've got to try and do is figure out what you're going to do on these trades, because when if you've got a red delta and it's a manipulation, it's usually bullish. This one here actually made money, believe it or not, because the volume was all at the top of this candle. So the market maker came in against that buying delta at the top of the candle and then closed lower. And obviously the market maker was able to make 2 or 3 ticks on that trade, no trouble. So the market maker, you might say, but it went up. Yeah, it did go up on this occasion. The market maker still made money because they don't trade for swings. They trade for 2s, 3s, 4, 5 ticks at a time. Okay. And then we can see on this one, the market maker's long at this price here, this green price, and the price goes up. The market maker then gets short at this red price and the price goes down. It shouldn't be too difficult to spot the market maker's operation against these little rotations, is it? Now, this is an 8x3 reversal candle. This is an 8x3 reversal candle. This is probably not detailed enough for scalping because as I said, when we're looking at this type of a model, the whole chart probably takes up about 2 or 3 minutes. So in other words, this tiny bit of chart here takes up about 25 minutes. So this is too slow moving to get a real good handle on the order flow. We would have to use, if this was our chart, as a scalper, if this was our chart, this would probably be about 20 seconds of action, yeah? This would probably be about 20 seconds of action in here. Now remember one thing as well, the market maker doesn't always win. Sometimes the market maker gets absolutely stuffed by the big commercials, but when you see the market maker getting stuffed by the big commercials, you should absolutely pay attention to that because that break-even price for that market maker becomes a gold mine. That's the 50 pullback kind of concept again, isn't it? 50 pullback. But what happens on oil? You can see obviously that the market maker goes very long here. They drop the liquidity down to this price here. So that's where the market maker's long, price goes up. See it? Anybody saying, yeah, but how did we know that? Because there's a fair amount of trade here, and they did pull it, but the price then goes bid. You can see this block order probably was the market maker sitting on the trade. Market maker probably sitting on the trade. Why? Because they got short at this price, didn't they? So if the market maker got short around about 36s and they can close a trade off at 16s, for a market maker, that's a 20 tick trade. That's brilliant, isn't it? Brilliant. And it only took them about 2 or 3 minutes to make 20 ticks. 2 or 3 minutes to make 20 ticks. And then what do we see? What do we see? Well, that's not manipulation. That's not manipulation. That's not manipulation. And yet this has a little bit of manipulation. Why is that a little bit of manipulation here? It's not a manipulation bar, but why could it be? How could that be a possible manipulation bar? Because there's a pin on the deltas, and the deltas are incredibly, it's just almost an open, and the candle does drop. Remember, once you start understanding this, it's not just about the color of the candle. You've got to take into account the size of the candle, because the institutional selling, remember, is very important. When was the last institutional selling that the market maker paid attention to? Well, we can identify that by finding the big down candles with big deltas. So we know that there was institutional selling at this price. And it's difficult to establish exactly, but if we go back to where the deltas were here, you can see that there was some institutional selling at this price. So we know there's an institutional seller still sitting here at 52.30s, and we know that that's still going to be a short trade opportunity. So when we then see, for example, a green delta and a down candle, we know that the market maker now recognizes that institutional selling, and we can be short the market. So there's an element that you've got to still make sure you watch for in the background going on that tells you about the commercial side of the trade. Okay? There's that element in the background allowing us to make a decision about what's kicking off in the background. And once we understand that, we can kind of make sense of this. So there's an institutional buyer. How do we know that's an institutional buyer? Because the market maker pulled their liquidity based on that trade. There's a lot of buying deltas coming in, and the market maker paid attention to it. And the market makers paid attention to it. So we can obviously understand that if that's the case, the market maker withdrew liquidity here and somebody bought the market here. Somebody bought the market here, and then they were really worried about this. So there's obviously been some institutional buying, perhaps off of this level. And therefore, we've got to be watching that level going forward as a possible trade opportunity. So when we see the price coming back into this area, we want to see whether the market maker takes the opposite view, which they don't. They're actually going in the opposite direction. Look, they've got a big withdrawal of liquidity here with very, very small deltas. So the market makers actually are bearish in here, not bullish. So therefore, as an institutional trader, as a trader, you're looking at this, looking for a candle that obviously shows something really interesting, a very big selling delta perhaps, and absolutely no movement, because that would suggest that commercial buyer is still in place, wouldn't it? If we got a big selling delta and a very small candle with perhaps a close just above the volume, that would tell us that the commercial buyer is still in place. Well, we don't get that. We get the exact opposite. We got very large down candles with a very, very little selling. That means that market makers are obviously going to be looking to try and keep testing lower and lower and lower prices until they figure this thing out. And what happens? The price just breaks. Boom. We get an unfinished auction at the bottom. So the market maker was absolutely correct, but we get an unfinished auction at the bottom here. And then we got a manipulation candle. Look. We got a manipulation candle. Market maker, if it's red, the market maker's long. And obviously at that stage, the market maker's now thinking this price is going to go up, don't they? Why? How do we know that? Because we've now got manipulation candles taking place here. They're giving sellers lower prices here, aren't they? You see that? they're giving a seller, because we know that there's negative deltas, a lower price. And they're giving a seller again here a lower price. They're starting to show up as a manipulation because the market maker's buying. The market maker's buying from those, sorry, a seller with a lower price. They're giving the seller a higher price. So the market maker's almost as if the market maker's giving themselves a really poor deal. Market makers never giving themselves a really poor deal. Market makers never give themselves really poor deals. So when I see this happening here and here, the market maker's giving sellers these high prices. How do we know it's a high price? Because it's a green candle. So they must be giving sellers higher prices. That's not a free lunch, guys. That's a costly trade for the seller. Almost guaranteed. The vast majority of times, not 100%, but the vast majority of times, this is almost a guarantee long trade. Boom. You see it? 2 manipulation candles, and then all of a sudden, you're $160 better off. You see it? 2 manipulation candles, and all of a sudden you're $160 better off inside of a period of about 3 minutes. So it's not that difficult to be a scalper, guys. You've got to read the narrative. You've got to obviously get into these kind of concepts, haven't you? And obviously you can keep watching for all of these. The market maker was obviously what during this process? Does anybody see any manipulation candles here? So the market maker was obviously bullish on this candle, and obviously that's not a manipulation candle, but this is different. What's the market maker on this candle? Bullish or bearish? The market maker is getting short. The market maker is getting short at lower prices. If the market maker is getting short at lower prices, what are they? Bearish. We get another bearish manipulation here. We get another bearish manipulation here. Is it starting to give you a strong storyline about a possible bear trade around this area? Market maker must be really bearish off 72s, 73, 74, 75. Does everybody agree with that narrative? If you don't agree, tell me so that we know that you don't understand this. But does everybody understand that this is a very bearish setup here? Market makers are giving buyers a better deal because there's buyers coming in. Market maker is the opposite of the delta. If the market maker is the opposite of the delta, but the prices are going lower, the market maker is giving a buyer a better opportunity. This is what we told you yesterday, isn't it? So if that's the case, the market maker must be really bearish off of around about 72 to 76. Really bearish. What happens next? Boom. You just made $450 in about 3 minutes. Now, if you add that $450 onto the previous $2,000 or $3,000 or $5,000 that you'd made on a 2-lot earlier, and you added another second contract to that, you're probably sitting on about $5,000 as a 2-lot scalper using this concept. And all you've traded is oil, looking at market makers' rotations and market makers' auctions as a scalper. This is the big exception, because you don't expect big breaks, but when you get them, you should be on the right side of the market maker during it, and you were on the right side of the market maker with this candle here, and this candle here. And there she goes. And there she goes. Now, I can't make this up, guys, because this is this afternoon's oil market. Do you know what I mean? We can't make it up. It is what it is. I mean, it's there for everybody to see and interpret. And obviously in the background, you would have some sort of developing narrative about whether you were commercially bullish or bearish a particular market, and how you would use that bullishness or bearishness to try and figure out whether you're going to go long or short into any one of these trades. I mean, obviously, if you're bullish in this phase, you're not going to take advantage of this because you know you're going to get a lower price for a commercial buy. Agreed? When do commercials buy? When do commercials buy? Candles like this. You agree with that? If I'm a commercial buyer for a swing, I'm going to see the market maker setting this up for a drop, and I'm going to be expecting, because guess what's going to happen to all those buying deltas? Guess what's going to happen to all those buying deltas that are creeping into the market here? They're all going to be doing what very shortly? Selling. So when I see the market maker setting this up as a commercial buyer, I'm going to start setting up a buy trade, knowing that the break is going to be 51.60. I'm going to start setting up a commercial buy trade around about. We're going to take it through to 51.50. We know that the trade is usually going to be about 45. I'm probably going to start buying that part of that trade because there's going to be selling coming in here and it's going to follow through. And so long as the volume isn't down here at 32, because if the volume was there, the market maker didn't absorb the liquidity on the stop run, I'd be concerned if the market maker didn't absorb the liquidity in the stop run. We might try and absorb some of it. Depends how bullish we were or if we wanted to get into that trade really rapidly. But with the liquidity at 50, I'd have been a little bit concerned about it. But the market maker did absorb the liquidity in the stop run. See it? There's the liquidity right there being absorbed by the market maker. That's them just basically closing off their book here. So if the market maker closed their book off here, the market maker must not be that bearish. If the market maker was bearish, they wouldn't provide the guys on the stops with any liquidity. And the guys on the stops would slip through this level like crazy. Well, they didn't slip through the level like crazy. They actually got out with a stop of 1s and 2s and 3s and 4s. So they didn't slip those sellers. Therefore, the market maker can't be that bearish. Otherwise, they'd have slipped the sellers, wouldn't they? And that volume would have printed a lot lower if they were bearish. The volume didn't print a lot lower, so they're not bearish. The market maker's not bearish. You might say, that's a hell of a bearish bar. The market maker is not bearish. If they were bearish, that volume node would be at the bottom of the candle. So when we read this, we know that this becomes a buying opportunity, perhaps, if you wanted. We don't have value in this chart, but this becomes a buying opportunity for commercial buys. I'm interested now. I'm excited now about buying this market off the market makers. And what happens? A bit of pressure, but look at the candles coming in. You can see why we got a bit of pressure, because the market maker took the other side of the trade. The market maker was still going short on this trade. So when we see that, we know that there's still a bit of sell-side pressure coming in, don't we? We know that because we can see it. We can see the candles developing. I mean, this is a real-time candle that develops. That's a negative candle, and this is a negative candle. But again, you can see that the volume is quite high on the candle. So guess what? This becomes an institutional accumulation here. It's now started, isn't it? It's now started. What we're really wanting to see is an up candle with red deltas. Because that means that the market maker is now giving sellers a ridiculously good price, which means that they now believe, and we're just reading the market maker, we're not reading the commercials, we're reading the market maker. That means that they must be getting bullish on a manipulation. Does anybody see a red delta with a green candle? Anybody see a red delta on a green candle? Yeah. There's the red delta on the green candle finally appeared just here, isn't it? So obviously what's now happening here is that the market maker is now starting to realize, wait a second, I know it's only a slither, guys, we get that, we understand that it's just a slither, but we can only start with something, the color of the candle and the color of the delta. So in that situation there, you've got to be looking at it saying, okay, we're gonna get this. On this one candle, The market maker has offered sellers a really good high price. Why would they do that? Well, they now must believe that this is now a bottom edge, and we can obviously watch for further evidence of that. Perhaps a big delta down candle, and the volume's all at the top. You know what I mean? If the volume's all at the top and the big delta down candle, it means they're trying to encourage sellers in, but nobody's biting at lower prices. So you're always watching that. But look at what happened next after that accumulation buy trade. Boom, money's good. Do you not see it, guys? We just told you this little bit of trade here, this absorption of those stops following that manipulation tells me that this is now a commercial long trade at these prices, just based on the order flow. And therefore, when we understand that, we're not guaranteeing that this trade's going to be a winner or this trade's going to be a winner, but what we are guaranteeing is that this swing is going to be a winner. Do you see the difference? It's now a swing trade. It's not necessarily a scalp trade, because the best scalp trades are momentum-based scalp trades. The best trades are momentum-based scalp trades, because obviously we're starting to get that message from the commercials to the market makers: get off. Be gone with you, because this market's going to go higher or lower. And obviously what happens to that commercial long trade is we get this beautiful, beautiful, beautiful swing. Perfect swing. Off the bottom edge prices of about 20 up to 80. So we end up making $600 on the commercial swing. Does it all not make perfect sense, guys, when you stop a second and think about it? When you actually get into the order flow properly, does it not start to make sense? Now, obviously, one of the things you can then add to this is when are the commercials going to be excited about this trade? When are they going to show up in terms of this trade? What are they looking for in terms of a trade opportunity to start taking advantage of this? Well, they're looking for the euro to maybe start going bid, aren't they? You know, why would the commercial take an interest in this area rather than up here? Why did the commercials buy this 30 level instead of buying the 50 level break? Why did they come in here instead of 70s? Well, let's take a look at that point on the chart in terms of value. Now take a look at the time. It's 1450. It's 1450. Does everybody agree it's 1450 on the charts? Yep. So we're not diagonally changing anything. We're not trying to make you look at something that isn't in existence. But if you look at 1450 on the chart, and I now bring across the value chart, does anybody see an opportunity for the commercials? Not the market makers, the commercials. Does anybody see an opportunity for the commercials? Do you see the euro starting to go up? Do you see the 10 spread diverging in the background? Do you see it? Do you see the 10 spread starting to go up and diverging in the background? Do you see the euro starting to go up? So anybody that's trading the euro has an opportunity on this downtick to hedge the euro, do they not? Yes or no? How do they have an opportunity to hedge the euro, I can hear you say? Well, let me draw a line. If I draw a line on this downtick on the euro here, and I draw it to the 10 spreads, does anybody see an opportunity to hedge the long euro on an uptick on the 10 spreads, yes or no? Do you see it? So how do we know this euro is going to get bought? Because you've got the perfect hedge for the euro now. You've got a big discounted price. It's just gamed the liquidity in the background. See it? So for a commercial, do you see the buy on the euro here? Because they're going to sell the red line and they're going to buy the orange line. So even though the euro's dropping, you know that the euro's going to go up, don't you? You know the euro's going to go up because you know the red line's going to come down and the euro's going to go up and you're going to get a hedge trade. You know that. But here's the point. Here's the key point. You know that information 1, 2, 3, 4, 5, 6, 7 minutes. You know that information 7 minutes before the commercial long trade on oil, following this order flow sequence. 7 minutes. You already know that this is a buy trade 7 minutes before it happens. Because obviously what you're now waiting for is you're now waiting for the commercial buyers to get a discount. There's the commercial buyer discount running through 60. Remember we talked about the stop run? There's a commercial buyer discount right there. That's it. That's how the commercials deal. They get a discount on the price. They know that the value is now going bullish. There's the commercial buy, the whole candle, not the bottom of the candle, not the top of the candle, the middle of the candle. The whole candle is commercial buying. And obviously what shows up in terms of volume? Do you get a volume surge? What do you think? Do you get a volume surge to show you that there's some commercial buying on this candle? Yes or no? What do you think? Does anybody see a huge volume surge for commercial buying on that candle? I mean, honestly, I can't make it up, can I? I can't show you something that doesn't actually exist. It's not a whiteboard drawing. It's the physical charts from today using the simple concepts that we teach every single day in this room about high volume down candles or commercial buyers. And it's not just the fact that it's a commercial buy, it's the fact that it's a commercial buy below a wholesale price level with the market makers telling us it was going to happen 7 minutes before it happened. Now you might be saying 7 minutes is not a lot of time. I'm sorry guys, but that's the kind of, in a lot of cases, that's how much time you're going to have to make your mind up about what you're going to do. Because you can't do it when the euro's dropping. But when you then see that the red line spikes up, the 10 spread spikes up, now you're saying, I'm going to buy that euro. And the euro currency guys are all buying euros at bottom edges, but you know that. And as an energy trader, you're saying, I'm going to buy the break of that 50. Congratulations. Welcome to the world of commercial trading. So you're going to buy 51.30s. You're now going to be long the oil, and you're now going to be looking for what happens next. You know there's a commercial trade in here, not a market maker's trade, a commercial trade. So you're not really concerned about the market maker. You've sold the sell, you've sold the squeeze, you've sold the squeeze, you've got the squeeze. Now you've got a commercial swing, because this squeeze was all based around the market maker's short trade. This bottom edge is all based around the commercial's long swing trade. What happens next? Well, what happens next, of course, is that the price, in terms of the commercial swing trade, what happens next, of course, is that the price, in terms of the commercial swing, moves all the way to the top edge. See the commercial swing against the market makers, and obviously in all of these areas here, there's market maker trades, but we know where the 50 line is. Remember we talked about the 50 line having the spring trade for the market maker. Well, there's the 50 line spring trade right there, isn't it? There's the 50 line. There's your buy side springs. There's your buy side springs, trying to game liquidity into these areas. And what you're now expecting is a measure from that block trade here at 51.20s up to the 50 line around about 51.80s, which means it's about a 60 tick trade. And obviously based on 60 ticks at 51.80, where's your target price? If the bottom price is 51.20 and the 50 line is around about 51.80, where's your target price? If you've got your bracket now at this level here, 51.20, 51.80, 60 ticks, 52.40 is now the target price for this trade, isn't it? Does everybody agree with that? 52.40 is now the target price. Well, what happens to price? You see it? I mean, you know, as I said, guys, I mean, we can't make any of this stuff up because you've all done the classroom. You've all understood the processes. You've all understood the spring trade, the commercial long trade at a discount price, the commercial long trade at a discount price, the spring trade in the top right-hand hold. There's the 50 line. You can see the spring trade takes place above the 50 line. The price then breaks to give us the change of behavior and the new 50 line price for the bracket. And then we make some projection highs based on that bracket bottom edge, 50 line, top edge. Okay. Now, obviously, you can see that you can see where the market makers might start taking an interest, because you can start watching these big buying deltas, knowing that the market maker is having to take the short side. So you want to make sure that the market maker is pulling liquidity away really hard on those buying deltas. If the market maker isn't pulling liquidity hard on those buying deltas, there's a high probability that that's going to be the top edge. So when we go along to the right-hand edge of the chart, you can see that there's a big buying delta here that they definitely pull hard, but look at where the volume is. See how it's at the top of the candle? Market maker must be really bullish on that one. Agreed? What about the next big delta here? Do you see where the volume is on the next big delta, guys? Do you see it? There's the big delta right here. But do you see where the volume is on that big delta? It's at the bottom of the candle. Do you see it right there? There's the volume at the bottom of the candle. What is that starting to tell you about the market makers? Remember, the market maker's getting heavy short at the volume node. If they're getting heavy short at the volume node, what are they doing? They're bearish. They're starting to get bearish, aren't they? So if they're starting to get bearish, would it be reasonable? Would it be reasonable to just move above the top edge there and start thinking about the possibility of getting short business into that top edge? Would that be a reasonable proposition for any one of you? We can see that there was a market maker manipulation on this candle, so we knew we were going to get the squeeze, agreed? The market maker's going bullish on an up candle, so we know we're going higher. Does everybody see the squeeze? We know we're going higher. Does everybody see the squeeze? The market maker's gone bullish. Negative deltas means the market maker is now bullish, and they give the seller a higher price. So if they give the seller a higher price, they must be bullish on this one candle. Boom, price goes up. But because of this candle that preceded it, I'm starting to think this is probably a top edge. Now, surprisingly enough, it's very close to that target price of 52.40. So the market maker's obviously trying to get a little bit of jiggery pokery going on in here to try and make the market flip over. And you can see obviously the big volume comes in here. You can see the big block trade. As soon as the price took out the high there was a big block sell. Who do you think that was? Market maker, eh? You got a big block sell, so that must have been the market maker sitting just above the stops. See how the big block was right above the stops? So the market maker must have been sitting on the book, waiting to take the seller stops, the buy stops, and then they just exhausted through to 52.40. That's why we didn't get 52.40, because the price exhausted through to that level. And then your job then would be saying, I get this. I now understand this story completely. So I now think that the market maker is bearish at 52.40s. I'm going to get a little short trade around about 28 once we get back inside that value. And all of a sudden, you've just gone 28 down to a price of 52s, $280 of very simple, easy order flow profits to the downside. It's off a key level. It's got some key narratives building in the background regarding where the market maker thinks the volume is, what the market maker's doing with that volume. Because if they were really bullish on this candle, guys, that volume would be at the top of the candle. Think about it. Because the market maker would not absorb the stops. They did absorb the stops. They did absorb the stops off this top edge, didn't they? not that top edge, sorry, this top edge. They did absorb the stops off that top edge. If they're absorbing the stops, they can't be that bullish, because if they were really bullish, they would just let the price run through to the top of the candle. They don't let it run through to the top of the candle. The price expires at the top of the candle here, guys. It just exhausts out. They're bearish. And obviously this becomes a top edge opportunity to rattle some sell side business into. And because the market maker's got a lot of shorts here and a lot of shorts here, we know where the short price is. There's the big volume there. So the market maker is heavy short at this price. Then obviously they're going to try and pull the liquidity down to try and get that price, aren't they? They're going to just pull the liquidity away to try and get that price, because the market maker now is in massive profits. The market maker is now in massive profits because they pulled the liquidity away because they started to pick up quite a lot of bearish side business. And they're now taking some profits out because you can see that they've pulled it right through that level. Enormous profit for the market maker. And if you follow the market maker's model and you overlay the concept of the commercials that are dealing so that you understand the commercial swing trades that are also available, all of a sudden trading can become not incredibly easy, because it's not easy, but you can start to see some of these trades on the screens. You can actually start to understand some of these concepts. Now take a look at that. Take a look at that move. Take a look at that move on oil up to that key level where the market maker went bearish. What do you see on the euro? What do you see on the euro? It's improving a little bit, isn't it? But it's not improving that much. You can see if we were doing if we were doing the spread trade, in other words, we did the +2 scenario. Does everybody see that the red line is in profit at this stage and the euro is also in profit? So the spread traders have made a very nice trade. Spread traders made a very nice trade. They sell the red line and they buy the euro. It's a spread trade. It's a hedge trade. So obviously we're not expecting the euro to explode to the upside, because obviously a lot of people have sold the red line. You can see every time the red line comes up spiking to the upside, they sell it. And what happens to the red line is it becomes a negative correlation to the euro, doesn't it? That's how you know there's a hedge trade taking place in the currency markets, because the red line will be a negative correlation, not a positive correlation. You understand that? Because if the market's in a positive correlation, it can't be a hedged market because it's just a directional bet. But if it's going in opposite directions, as it did here, we know it's a hedge trade. We know this is a hedge trade. And generally, as a rule, the euro will move in the direction, obviously, of where the red line is, and the red line will move in the direction of where the euro is, because it is a hedge. As the red line goes up to the top edges up here, and the euro drops back down, another hedge. As the red line goes away up to the top edges here and the euro drops down, another hedge. So if you're a currency trader, you'll be able to see if the hedge is doing exactly what you thought it was doing and pick up these long trades all the way through this process. The euro will go up and the 10 spread will go down. The euro will go up, the 10 spread will go down. So we know that this is all hedging that's going on in here. Okay, so we know it's all hedging that's going on in here. You can see exactly the same happened again here. You can see that the hedge was still traded here. But one of the things we can see in here is that it is still getting hedged, because the red line starts going up and the euro drops. So they can't be that confident about the euro exploding to the upside, because if they were confident about the euro exploding to the upside, what would they do with the red line? They would stop selling it at top edges. They wouldn't hedge, and they would just allow the euro to then move in the direction of the red line, wouldn't they? So what would happen on this chart here? What would happen on this chart here is that if we've got a situation whereby the red and the orange line is doing this, okay, so let me just take you back a little bit here. Okay, so there's the red line doing that. Oopsies. And there's the euro doing this. That means that it's getting hedged. That's a hedge that's in place. So when the orange line does this and the red line does this, that confirms that the hedge is definitely in place. So when the red line does this and the orange line does this, that's the hedge still in place. Now, what happens next, obviously, is if the red line starts coming down and the orange line does the same here, we're still in a hedge position. But what happens if the traders are starting to get really bullish the euro? What's going to happen if they're really bullish the euro? Well, what's going to happen is that the euro is going to do this. They're going to unwind this red line entirely. The red line is going to do that. And you're thinking a hedge. You're still thinking hedge. You're still thinking hedge. But obviously, because they don't sell the red line maybe still does that. And the euro stops dropping down, perhaps, and we get a top right-hand hold. What's going to happen next is that's going to happen next, isn't it? They've stopped hedging it, and now they expect a directional bet on the euro. Okay? The red line in this case is just the 10 spreads, so the German US 10 spreads. In other words, the biggest hedge market that is used for the euro-dollar trade. So if we saw that happening, then obviously it would be really bullish the euro, and we'd also be really bullish the oil. Really bullish the oil. If it doesn't happen, we can't be really bullish the oil. And obviously it's not happening here, look, because the euro's going up, but every single time the 10 goes up, the euro actually drops back off. So you're now thinking to yourself, at that price, I think this is possibly, it could be a top edge short because there's a value divergence in the euro. Look, take us 10 spreads off a second. And is there anybody that doesn't see that value divergence against that wholesale change of behavior level right there? Now, we've obviously also got a target price of about 40 on the basis of these levels moving forward in terms of change of behaviors and blah, 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 blah. We've got a target price up here. We can also see that we have a very, very, very significant value divergence. So there's a very good chance that there's a commercial reason to get short at this price as well. Well, see if you can start adding a commercial reason to get short and a market maker activity suggesting that the market makers are short. Remember, the market makers are very similar to the commercials. Market makers will sell on upticks. Prop desks are momentum traders. In other words, speculators are momentum traders. Speculators will buy at higher prices. That's why you see in the COT, for example, that's why you see that the commercials have a negative correlation to price, but when the commercials get really heavily involved, the price generally stops and the price spins on a dime and the price then reverses. So these are the types of things that we're now paying attention to. And obviously what happened next is that we simply got that commercial short in line with the fact that the market maker was now starting to get short, in line with the break above this key wholesale, which is just this change of behavior. Remember, what is this price? What is this price? Well, this price is very, very obvious. It's just a pullback. Remember, we says that it's usually going to be the 50 line in the big picture. Remember, we talked about the 50 line being an incredibly important price in the big picture. Is there any significance, therefore, to the fact that that was a swing high, that was a swing low, and this was the 50 line at approximately the same price? Any significance? Yeah, you bet your bottom dollar there's a significance to this. It's got nothing to do with Fibonacci. It's to do with simple arithmetic. That's what it's to do with. So we now know that this is also a 50 pullback. It's also the it's also the measured projection. It's also the change of behavior. And we see the market maker absorbing stops. What else do you need to see to get some short oil, guys? What else do you need to see to get some short oil? Maybe some short-term selling coming in the euro. Well, if I take you along to the decision, do you see any short-term selling coming in the euro? It's right there, isn't it? It's right there. And obviously what happens next is the price then trades away from that level. So when you start looking at it from that perspective of adding the commercial trade to the market maker's trade, A lot of people say, well, do you prefer the commercials or do you prefer the market makers? Then obviously I'm going to always prefer the commercials, but when I get down into the order flow chart, I change into the market makers to find the right trades in line with the commercials. So I'm not going to foot it, you know, fair enough. We're going to scalp and do business around all of these kind of areas, but the commercial trade is here and the commercial trade is here, and the in between is all market making information that we can use to see exactly that we're going to get to our target price or fail to achieve our target price, isn't it? And that's what we've got to try and do when we're using this type of trade. You can see if there's a lot of selling deltas and the value is at the low as it is at the moment, the market maker must still be relatively bearish. Otherwise they would have absorbed that stop run, wouldn't they? They must be still relatively bearish. Otherwise they would have absorbed that stop run as soon as the price came out here, but they did take it lower. So the market maker must still be relatively bearish. Was there any manipulations that we could use? Not really, because the two green candles had some green deltas. So we can't highlight any particular manipulations, but we did see that the market maker is bearish. But look at what happened in the next candle. It dropped. You see it? So if you know that the market maker is still bearish here, you could have obviously sold maybe this little pullback and got some short business, maybe for about another $100. It's a good scalp trade because you knew the market maker was bearish because of where the volume was on that selling delta. You knew the market maker was bearish on this candle because you see where all the volume is. It's right on the bottom of that candle. So we know the market maker must still be bearish on that because otherwise they might have absorbed it an awful lot earlier. But they didn't. They took it all the way down to this price. So they must have been concerned about the price getting to that. You can see that bearish market maker, even on a low price, I was still able to tell you that they're bearish and that they expect the price to go lower. And look at what's happened. It's now went from 77s down to a price of 64s. It's now went $130 to the sell side. $130, guys, and that's only taken the last 60 seconds to find that trade, get into that trade, make some money. Think about it. Think about the power of that information. And yet it's about reading the tape. It's all about just reading the tape, finding the right trades, reading the order flow. And this is where market profile actually can be really useful. And it's the one use that they don't really use market profile in when you look at Stadelmeier or Dalton. You don't really look at Stadelmeier or Dalton and see that trade. You can see the market maker must have went bullish here because obviously what's happened is the market makers went bullish, but they've given the seller a higher price. So the market makers temporarily went bullish on this trade now, haven't they? So you know that as the price then comes up into this area, the market maker is going to try and make some money as the market breaks off that volume. Now they've gone bearish again, but they still made probably about 5 or 6 ticks on that trade. Think about it. You might say that never worked. It did work. It worked perfectly. It was just that there was still some selling coming in that the market maker says, oh, well, still some selling. I'm just going to rotate it back. That's okay. The market maker's not in any danger here. And they pulled away the liquidity again and let the price drop through. Now the selling is still heavy volume to the downside. Still heavy volume to the downside, but there's a big block print that's just appeared there. So you're going to be watching now to see the same type of trade. Now the market maker's pulling liquidity above the market. Why are they doing that? They're obviously a little bit concerned about possibly a buyer starting to step into the market. Market maker, very, 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 very small number of buy-side deltas. And yet the market maker's giving, obviously the market maker's doing, everything they can not to give buyers a high price. So we're going to be watching this now to see if selling comes in, because if the delta goes sell side and the candle stays green, they're giving the seller a great price and the buyer a terrible price. And that's quite interesting because they did try to take it higher. They lost that. The delta stayed a little bit positive, so we can't really use that as a trade. So we just have to assume at the moment they still have this overall position that they're still relatively bearish. But guys, this is just practice. There's nothing special about anything I've talked about today. There's nothing that we've talked about today that you haven't already done on your charts And when you think about what we started with talking about, we started talking about this process of the candle and the deltas, the candle and the profiles, the candle and the idea of where the open and the close is against that delta print. And that's what the pit traders do. This concept that the pit traders use, they're looking at buying, we're talking about the locals, the guys that provide liquidity. And the locals that are providing liquidity, they're watching for the commercials across the pit. And if they see commercials across the pit, they stop buying from them because they know that commercial is going to railroad them right through that price. They're just going to run clean through that price, and the trade's going to be a horrible trade for the local, okay? So when we start to understand that, one of the things we've got to start understanding is that when trade comes in, when the commercial comes in and the local wants it, the local either knows that the commercial is exiting a trade, so it's not them getting net longs or getting shorts. It's not the commercials exit, it's not the commercials getting into a new trade, it's the commercials distributing. So when we see that commercial distribution, the locals will take that side of the trade because they obviously are quite happy because it's not them getting sell side against them, they're getting sellers distributing, and therefore they're not taking on a new position, they're taking on somebody that's getting out of a position, and they could probably railroad the commercial at that stage. That's why when the market maker knows we're going to take a profit, they a lot of the times rattle the liquidity so that we can't get off the trade, which is why we've got to keep buying on down ticks to get off a short trade and selling on up ticks to get off a long trade. Because we need to try and step in front of the market maker, because the market maker is just going to flip the trade over against us and we're going to end up not being able to get out of the business, okay? You can see that there's still a big withdrawal of liquidity on this phase. Look, there's still net selling deltas, but look at what's happened to the price. Do you see it? So this is a bottom edge. Make no mistake about it. It's also a key wholesale price, 51.50s. This is a bottom edge. The market maker is getting net positive at higher prices. And we'd already identified it on this candle here when we started to see what was happening. So the market maker is bullish here because they're starting to give the sellers higher prices, net higher prices. So we know that this is going to be bullish. We know it's got a chance of making it to the upside. But guess what you should be doing just now? Finding the last commercial seller. Where was the last big commercial seller? Well, there was good volume here, good deltas here, and it was a good strong down candle with volume built at this price. So the market maker must have detected a commercial seller at this price here. So if you're in a long trade here, you would be using that 80 price as a first possible target price. You see how we can do that? If you've got a big selling delta and the volume's all at the bottom of the candle, then you must think that the market maker must have detected commercial selling for that candle and that delta to happen. So therefore, this level is something that's very interesting to you, and you can see exactly what's happened. The price has just traded 80 and stopped moving higher. It's just traded 80 down to 70. Do you see it? Do you see it? So there is a commercial seller here. The market maker knows there's a commercial seller here, pulls the liquidity up to that, and obviously there's absolutely no buying coming in. They've pulled the liquidity, there's nothing here, and the price rotates off by 15 ticks. We drew that level in before it happened, guys. You might not believe it, but we did. We drew that level in before the price rejected off that price there at 80. If you look back in the recording, you'll see exactly that that's what happened. You see how it's possible, guys, to work your way through this? All we've done is we've highlighted we've highlighted manipulation candles, for example, and we've looked at those manipulation candles as pieces of information, not as trades, but as pieces of information. And through that piece of information, we've then been able to analyze the idea of what's happening in terms of value, volume, deltas, and price action. Well, surely if you can add value, volume, deltas, and price action all together into the mix, you've probably got the perfect trade. Well, the answer is, yes, you do. You have the perfect trade. because you're using all the elements that we teach in this room: price action, volumes, deltas, value analysis. Everything is in the trade right there, isn't it? Everything. And if you can see it, well, you can start dealing it, can't you? You can see the market maker is still getting bullish. See how the deltas are still net short right through this period, but the price is still going up? Market makers are really bullish off this downtick. But there is still a commercial seller at 80 that they've still got to be paying attention to. And that's why you can see the big volume appears at slightly lower, around about that 72 price. And obviously, if we can start to see the delta starting to get absorbed, we know the commercial seller's still there. If the delta starting to get absorbed, we know the commercial seller's still there. If we see the delta's not getting absorbed and it pushes through that level, we know the commercial seller has gone. And that becomes a possible buy level on the way back down again, doesn't it? Now, what would be the ideal strategy here? The ideal strategy, of course, would be to see a selling candle with a green candle. A selling candle, as in selling deltas with a green candle. That would be the perfect trade, because that would tell us that there's sellers coming in, but the market maker's quite happy to take the selling on at a higher price. The market maker's going bullish at a higher price. That would be the perfect candle right here, wouldn't it? And obviously in that type of situation, you'd be able to look at it and say, I know exactly what's going to happen next and take it forward. But if you were on a lower auction, you would start to see this stuff in a little bit more detail. The commercial seller that came in before that was the last big delta with the volume at the bottom of the candle. So the last big delta with the volume at the bottom of the candle was this candle here. So we know that the commercial selling must have been detected at that price. Surprisingly enough, the break of 52. You see it? So that's where the last big commercial seller must have been detected by the market maker, because that candle can't form otherwise. It's impossible. It's impossible for that candle to form unless there was a commercial seller detected at 52.04. The market maker pulls their liquidity really quickly, doesn't absorb the stop run, and then takes the business at a very, very low price, allowing them still the opportunity to make some business there on that rotation. You see that? So you can see that this bullish bottom edge at 50 has been absolutely spot on perfect, hasn't it? When you think about it, spot on perfect. You can see the price is still going up on buying deltas, so we can't really read an awful lot into that. We're just going to have to wait to see if a new buying situation or selling situation sets up that we can then say, okay, I kind of get that now. I kind of see what's going on here. I mean, there could be a big absorption by the commercials here, but you've got to remember, the other thing you can be looking at, obviously, during this is your value charts. And you can start saying, well, would there be a reason for the commercials to sell here? This was technically a failed auction, and this was the big commercial level at the bottom of this chart. Remember that? Do you remember that commercial buyer down here? Sorry, did I say seller? Remember that big commercial buyer in here? Well, that's the same price we've just touched. You agree? It's the same price that we told you about at the start of this classroom that the commercial buyer had appeared from. So if we know the commercial buyer had appeared, this was the whole trade with the euro and all that kind of stuff. Well, if you'd drawn that level on your charts, you would have had a very large, and we did draw the level in the chart, by the way, guys. There it is there. Remember this? You'd have already have known the existence of that level, and you would have been prepared and ready for the buy trade, wouldn't you? So when you saw that selling delta coming in and the prices were working their way higher, you're saying the sellers are getting a damn good deal. I know why they're getting a good deal, because this price is now going to break higher. I'm going to start buying downticks. I'm going to start buying 2 or 3 tick back pressure downticks. And obviously what's happened next is we've just absolutely moved this price beautifully in this transition off the bottom edge at 50 back up to high print price of 88s. That's sensational, guys. Absolutely sensational. And obviously we've got a possibility that we're going to start looking to game that 52 by the end of today, aren't we? That's what we're going to be thinking that we're going to be looking to try and do, is game the 50 by the end of today. Is it right to think that every commercial buy you see at the start of this move, you should see similar distribution in terms of volume? Yep, absolutely. Absolutely. If they're heavy buyers, they've got to be heavy sellers. If they're heavy sellers, they've got to be heavy buyers. They've got to get rid of their trade. It will show up. It will show up. And obviously, you can look at that in terms of making a volume model where you've got equal size volume distributions. But remember, it's not as easy to see it as a single price point. What I mean by that is that if I believe that this was a buy trade and all of this volume was buying, then obviously the distribution takes place on all of these upticks once we get above this 50 line. So part of that volume, this volume here is definitely part of that distribution. Well, that's about a third of that total volume, yeah? So that volume in this candle, and I'll just mark it for you, the volume in this candle is about a third of the volume of the buy trade. So there's about a third of the distribution takes place here. But when you add all the volume of all of those up candles, you'll find that all of the volume of all of the, by the time we get to this point, you've probably fully distributed, haven't you? In terms of just pure volume, you're probably fully distributed by the time we get to this point. Well, that makes sense, doesn't it? Because now what we can see is that any move higher is now an opportunity to get net shorts. So we can see that that move higher here is now an opportunity to get net short business done. And obviously the volume that comes in off the top edge, the buy and the sell volume that comes in off the top edge, is then open to distribution. And what we start looking for is that distribution process on the way back down through this 50 line again. And when we break through this 50 line, we start watching the volume building, and you can see that that big down candle plus that big down candle is probably the same as the volume that came in here, isn't it? So the distribution probably finished on the last big down candle, which is this candle here. The last big down candle was this candle here. So that's probably where the distribution finished in terms of pure volume. And then any price below that is an opportunity to maybe buy some oil. Yeah, buy some oil and take the market bid off of that price with a target price, obviously what we just discussed of 52s. The pink and yellow lines on Sierra charts here is the time segmented volume, Dan. Sorry, who asked the question? Well, Harry. It's time segmented volume on Sierra charts. It's not the histogram. It's just the moving average, basically the moving average of the volume lines. So when you're looking at time segmented volume, you're looking at lower highs and higher lows to know where the trade is starting to take place. So when we zoom in on this, you can see this bottom edge distribution. This bottom edge accumulation. Can you see it? Can you see the bottom edge accumulation, guys? We should have a divergence on this trade. Do you see the top edge accumulation? You should have a divergence on that trade. You see it? So when I take you along to this chart here, do you see where the big accumulations take place on either side of the trade using time segmented volume? There's the highest peak here. So obviously if that's the highest peak, when we've got these divergences happening, this must be, these big block orders up here, all these big yellow block orders must be short accumulation. So when we start seeing divergence during this period, all of these blue block orders must be accumulation. Yeah. And that's just using the peaks in volume to then establish the idea of where that trade is probably located in terms of key swings. And that's why the time segmented volume can be quite useful. That's why it can be quite useful to see time segmented volume. When you're zoomed in like this, you don't really get an appreciation of the trade, but you can still see the divergence on the pink line. You can still see that concept of the divergence on the pink line showing that the volume is now peaked and we're now into the possible buy phase of the market off the bottom, yeah? always block orders at the top? Yeah, in most cases, yeah, absolutely. Because block orders, you know, if they can get filled, will get filled, you know. I mean, a lot of the times you don't get filled, so it doesn't show as a block order. But if you can get filled on a block order, then why the hell not? Absolutely, take it. So when we do see it happening, we can obviously start looking at that block order and say, okay, well, that was interesting. Somebody decided to do active business there. Why did they do it? That's why we look at the price action that happens afterwards. Any questions about this, guys? I mean, are we quite happy? I know it's a big, long classroom regarding purely the market maker's auction, because that's all we've talked about is the market maker's auction inside the world of the commercial trader. But when we add the market maker's auction, when we add the market maker's process to the commercial trader's process, you can really start finding great stuff everywhere on your charts, can't you? You can find great stuff everywhere on your charts. And when you understand that, you can start to say, okay, well let's get busy. I'm going to start looking for market makers activity at the bottom edges of the commercial buying phase. I'm going to be watching the time segmented volume. I'm going to be watching value. I'm going to start drawing some lines on my charts, and I'm going to make some great decisions. Okay, let's take a little break, guys. When we come back, we'll take 3 minutes break so we can get a triple in the into the machine. We'll take 3 minutes break. When we come back, we'll just talk about where we are just now in terms of the last couple of days bond auctions. We'll show you where we are on the charts in terms of the bond auctions. 3 minutes break. Guys, we're going to touch on order flow to start with, and the reason why we're going to touch on order flow is because we've spent so much time trying to get you guys to get the macros right. I can almost guarantee, I can almost sense that you're forgetting about the short-term order flow to make sure that your structure in terms of your trade entry is nailed on as close as possible. And in terms of trying to find some great trades, you're looking to try and put some information in your favor. And that information in your favor can be things like trapped buyers. How do we find trapped buyers or trapped traders? Let's change it to trapped traders so we don't have to type it out twice. How do we find trapped traders? Well, you can obviously use Sammy's little indicator called trapped buyers and sellers, surprisingly enough, or you can just simply look at market delta. You can just look at market delta. What does trapped traders tell us? Well, a very large delta candle, for example, should be pretty obvious. If I drew a little piece of chart at the bottom here, just for no reason, just into this area here, I'll just draw a quick candle, and I'll draw another quick candle. Which candle has trapped buyers or sellers on it? Well, the first candle has this number of deltas, and the second candle has this number of deltas. Well, obviously, anybody that's looking at this would say, well, if, and it's a big if, because there's a lot of deltas coming in here, the delta market delta guys call this a delta surge. If that delta surge is successful and we start popping hard to the upside, if there's some upside value, you're certainly not going to try and trade against it. However, if the price gets absorbed and we've got a reason to be short, then obviously that trap delta has to unwind and we're going to get the same selling coming in below the break here, yeah? Below the break. So in that type of situation, we can obviously watch market deltas. Or you can just watch for the trapped buyers or sellers candle appearing and we can take advantage of that. What else would make sense? Well, if we get trapped buyers and we get a level 2 sell, do you think it's trapped buyers? If we get trapped buyers in terms of the deltas and it's a level 2 sell, as in the case like this one, think about what it is. Level 2 sell plus trapped buyers. Is it trapped buyers? What do you think? Is it trapped buyers? Surging deltas, a level 2 sell. The answer is we don't actually know. We don't actually know if it is trapped buyers, but what we can probably come up with is that it's almost definitely a stop run. Because what is a stop run? On the basis that this is a level 2 sell, there must have been a level. Agreed? So if there's a level, there's got to be stops above the level. If there's stops above the level, what are those stops? They're obviously buying deltas, aren't they? They're obviously buy-side deltas. So as we break through a top edge, there's going to be some buying deltas heading into the book. And that's going to give a delta surge at a top edge, which is instantly rejected. It's going to give you a buy, and if it was buying deltas, there would be a good chance, and if the market was still bullish, there would be a good chance the price would obviously wipe out and would just explode to the upside. But the fact is, if we get a level 2 sell plus the trapped buyer at the same time, as we did on this occasion, there's a very good chance that all that's happened is they've gamed some stops. You know why they've gamed stops, because the value line is now dropping, and therefore this combination is the perfect sell, isn't it? Really, this is what institutions do in terms of value, isn't it? Because if the value is dropping, and you can see the green line on this chart, this oil chart is dropping, if the value is dropping, we want to try and get people getting gamed at top edges. So we want to try and find those buying deltas at top edges, because a buying delta is a stop. We want to find those guys. We want to sell to them because they need to buy at that price, don't they? Because it's their stop, it's their exit. So we want to sell to these guys. So this combination of level 2 sellers and trapped buyers with the volume at the perfect top edge price of 51.50, with the open and the close below the volume, and then this rejection, you've got to look at that and say that is as close to perfection in terms of a simple order flow trade as you will ever see. You see that? It's almost the perfect order flow trade, because why the hell would anybody want to buy if the pressure line's declining and if the value line's declining? Well, nobody would want to buy, would they? But there's going to be some algorithms buying it to try and squeeze the guys that don't want to buy but need to buy if you get stopped out. Know what I mean? It's a stitch up, in other words. This whole trade is one big stitch up. And yet we've been able to highlight this trade as being a stitch up by seeing that HTB in level 2 sell at the same time. And if the value was obviously going up, it wouldn't be a stitch up, would it? Because then you'd say, well, what the hell are these guys absorbing that breakout for? They're just probably taking some profits. And what's going to happen is the price is going to recover to this, maybe this green buy side imbalance, and then just go bid back off the level again, isn't it? You see that? So this is a stitch up. This whole trade is a stitch up. We've managed to do exactly what you would have worried about happening. We've managed to do exactly that trade. And obviously what's happened is we've just annihilated everybody to the upside. Now here's an example of a stitch up at the bottom edge. Now unfortunately, unless you were following your Euro trade at this stage, you'll not be able to see the value of why the trade made sense. But let me show you a buy-side stitch up. Does everybody see the buy-side stitch up here? Look at the candle. Look at the level. Look at the level. Look at the candle. Look at the price level. 50-50. Do you see all of these things? A previous swing low, the 50-50. The price breaks to the downside, goes back to the top side, closes above the volume, and we get a level 2 buyer appearing and some heavy trapped sellers. Heavy trapped sellers. We're now targeting that sell imbalance above us. This is a stitch up. Now you might be saying, I don't understand because the euro's dropping at that stage. Well, you know, sometimes, as I said, sometimes the euro's stitching up everybody as well. Perhaps there's a buyer coming in on the downtick on the euro, but in this case, I can't point you to why the trade is making sense without looking at other pieces of information other than just the euro. But this is a perfect example of how to read order flow, rather than a perfect example of how to read order flow in relation to value that's developing. So it's not as good as this sell trade, but in terms of how the order flow is set up, it's pretty damn good, isn't it? It's pretty damn good. So what happens next, of course, is we get that break back to the upside. It's absolutely perfect. The price just went from 50.50 to a high print price of 50.85, and that gave you a great combination of trades. Now, when do we know this is a level 2 buyer? When the candle closes back inside value, of course. Then we obviously know that at some stage in here that we've got a level 2 buyer, and obviously on that basis, these sellers who are now weak-handed, once these guys get taken out, we'd expect to see a pop to the upside in terms of price. And that is exactly what happens once we get into this sell-side imbalance here. Once we get into the sell-side imbalance, look at what happens. Big gap between the volumes. Reason being, sellers throwing up the positions, and off the price goes up to 50.88 from 50.50. $300 of absolute beautifulness. You see it, guys? I mean, I can't make it up. It's on the chart. I mean, it is what it is. I can't make it up. So when we understand this, here's a level 2 buyer in here. Was there a reason for it? Well, perhaps there was this idea that we were going to be buying the euro again at the bottom tick price again at 2 o'clock, and that's what I was talking about to you guys earlier. So the euro's not the value line we're interested in, but take a look at the candle. Take a look at this level 2 buyer that came in here. Now, we don't get any trapped sellers like we did over here, but take a look at the candle, stopping volume. See the yellow line? Stopping volume. There's no selling coming in, but we've got stopping volume. We've then got an exhaustion print. We've got volume at the bottom and the open and the close above volume. Very good chance that that's going to be a reversal trade. 50, 60. It's got a level 2 buyer behind us. Right there, level 2 buyer right there. 50, 60. Look at what happens 20 minutes later. It's trading 51.40. It's worth $800 in 20 minutes. It's pretty good, if you ask me, when you combine those elements, isn't it? Pretty damn good, if you ask me, when you combine those elements. And then when we started to sell off that 51.75 level, the open and the close below the volume, I don't get any cheeky level 2 buyers or sellers or any types of narratives up here that we can point to as having a special piece of information. But it is what it is. It is what it is. We can only show you what we can show you. And obviously in that type of situation, you can see that we've had a great little trade off to the downside. The value was divergent a little bit. We then come up, we got a reversal rob trade up here. We got a failed buyer's auction up here. The price then sold off of that failed buyer's auction for $200 in 15 minutes. So all we're doing, guys, is we're taking some screenshots and we're showing you the screenshot, we're showing you the theory, and we're trying to get you to understand the value of knowing where the order flow is giving you a trade opportunity. Because the problem for most retail traders is they might be able to spot value just because of the concept of divergence. Every single retail trader in the world knows what divergence looks like. So they should be able to understand value quite easily so long as they have the skills, and I'm talking about skills now, but so long as they have the skills to change a chart from a 5-minute chart to a fucking 1-hour chart or daily chart, then they've got the chance to make sure that they've got the right value understanding of the marketplace. And we've even developed the idea of value building beyond that in a little classroom we did this morning, and we'll develop into that again in this little classroom. So for the retail traders, I don't think the value is really that difficult. As I said, so long as you've got the ability to make sure you've got the right short-term and longer-term value on your charts. Where the difficulty lies is then pinpointing the opportunity. Now, we've told you what the institutions need to trade. Liquidity, which means you should always be looking for these level 2 sellers and buyers. And I think it was, if I'm not mistaken, it might have been Miguel says that the change in his trading came from, and forgive me if it wasn't Miguel, but the trading from his trading came from the recognition that the auction had failed on a break to the downside or to the upside. And you was able then to say, well, you know, I can use that information to now give myself an ability to enter into that particular trade entry. But you can see this in real time. That's the point. It's not a hindsight. Yeah, this candle develops. This volume moves up and down. The level 2 selling will develop into the trade eventually. The price might come back inside, go back outside, and the level 2 sell isn't a level 2 sell. So, there's a lot of things that could happen during this trade formation. But at the end of the day, if you just take it as an end of candle scenario, and you'll be able to see these level 2 buyers or sellers on the screens, you'll be able to recognize them, you'll be able to then highlight them, you'll then be able to put a trade idea together based around what is happening with level 2 buyers and sellers. Then one of the things you can do is you can say, I recognize that candle. Now, if I can recognize that candle, can I use that information to try and take advantage of what's happening in terms of either the value read that I've got or the value read that I think is now going to be happening in terms of price bounces on the value line? Can I use that information to get the perfect trade and the perfect outcome? Can I target weak buyers or sellers? Well, obviously, trapped buyers at a top edge don't necessarily mean that there's a breakout buyer in there. It could just simply be a stop run. Now, obviously, if it doesn't have value, the trapped buyer might not be stop run. It might be a momentum algo trying to take the market bid, in which case you're just aware of perhaps some buying pressure coming in against you. But when there isn't any value in the trade, and you can see quite clearly that the trade should be getting sold, you can use these elements to find the perfect trade opportunity. Now, the one thing you'll always see me doing on the chart is finding those key levels. What did I do with the buy trade? What I did with the buy trade was I found the 50-50 level at the bottom and found the buy trade. What did I do with the sell trade? What did I do with a sell trade? I found the 51.50 level at the top for the sell trade. What did I do with the sell trade on oil the last time? I found the 51.75 level to find the sell trade. What did I do with the natural gas trade? We found the big level at the top edge, the big handle at the top edge to get the short trade on. What did we do with the pound? We found the previous day high to get the short trade on. Previous day high to get the short trade on. So these levels don't suddenly just appear from nowhere. There isn't suddenly some randomness about when we enter and when we don't enter. You should always be aware that the entry will have a big surge in volume and it's probably going to be at a key level. Well, if you know that, what the hell are you dealing in other locations for? Unless you're a scalper, a Momo type scalper, you're buying before she goes type trades. That's fair enough. You're not going to be at a key level because the key level was a fade trade. But what are you trying to fade other levels for? What would you try and fade 85 for, or 87? Why would you do that? Well, perhaps the value was getting so good that you got a level 2 seller at 87. You say, I'm going to take at least my first swing, but just accept that there's a high probability that if you sell at 87s, you're probably going to get squeezed out at the 100, aren't you? Because they're probably going to see that liquidity, and any failed auction is going to be a buy, squeeze, so that you can buy into that trade, squeeze the shorts, and then try and get the price up through the handle. It's not as difficult as you might think, is it? There should be a matrix attached to every single trade you take. The matrix is based around the volume, and the volume is based around the time and the levels. Volume is always based around time and levels. When's the highest volume of the S&P? 2:30 and 9 o'clock. Why is that the case? Because the open and the close. Where's the biggest volume on the NG? Well, some key levels. US cash open, US cash closed. Where else? Weather news. We get a spike in volume when the weather's significantly changed. Where are we looking at for the pound? 8 o'clock in the morning. Absolutely. Where are we looking at the S&P in the morning session? 8 o'clock in the morning. 8 o'clock in the morning, we're looking at the S&P. Are we going to be doing a deal at 8 o'clock in the morning? You might be saying there's no volume at 8 o'clock in the morning on the S&P. There isn't, but there's volume at 8 o'clock in the morning on the FTSE and the DAX, and they're the markets that's going to drive. And look at what happens. 8 o'clock in the morning, price is trading up into 8 o'clock in the morning. Top edge, Boom, over $1,000. It's not that difficult, really, is it? It's really simple when you put it into a little summary like this. It's really simple. It doesn't mean you're going to get the first trade right at this level or the second trade right at this level, but you've got to work that level now. You've got to try and understand that there is a trade, and obviously this trade here is based upon something that we're going to be talking about in classroom once we finish this little section, and that is the shape of the curve. So this was a perfect short for me. It was the perfect location, it was the perfect liquidity, it was the perfect level, it was the perfect time of the day, and we ended up with an enormous profit to the downside. Enormous profit to the downside. Killed it. Absolutely destroyed it. Absolutely destroyed it, guys. So what else are we looking for then when we're looking at these things? So we've just established that in the right location, at the right time of the day, in the right key levels like 5150 here, we want to start looking for trap buyers. We want to start looking at market delta if you're not using a trap buyer indicator. Some sort of market delta that's surging into the market being absorbed. We're looking for absorptions. We're looking for exhaustions. And then we're looking at this idea of saying, well, we've got something to target. So like buy-side imbalances. Now, some of you might say, would it not be better to get a sell-side imbalance? For a retail trader, as a momentum trade, yes. As a momentum trade, yes. If you get a sell-side imbalance, it means that there's been effectively a withdrawal of liquidity on one side of the book, and therefore you should be able to make money by buying away from the buy-side imbalance and selling away from the sell-side imbalance. But that imbalance is a scalp trade. It's got to be. So if I'm going to target a buy-side imbalance, the reason why I'm targeting a buy-side imbalance is because obviously that's another way to identify that there's possibly still some trapped buyers at a certain price. So when I see that buyer being trapped, then fair enough. But you can trade in terms of scalp trades, guys, once you see these imbalances developing. You can see, for example, if I just looked at buy-side and sell-side imbalances on oil, you can see that if I took a pop at this sell-side imbalance here, you can see it traded lower. If I take a pop at this buy-side imbalance, I probably wouldn't take a pop at the buy-side imbalance here. The reason being the volume is above me and I'd be trading up into the volume, and that's a bad trade for me. If I traded away from this sell-side imbalance, there was a sell-side imbalance came in here. Yeah, possible. This buy-side imbalance here, as it was going up, the volume was below me. This would have been a nice momentum buy trade, carried on nicely. And you can see obviously that this little buy trade here, which happened in real time, I can't tell you where the volume was because I didn't see it in real time, so I don't know where it was. So you can use these to scalp information from. If you've got a buy-side imbalance on your order book, that means there is obviously some sort of withdrawal of liquidity by the market makers. Otherwise, why is there a buy-side imbalance? But we want to target buy-side imbalances. This is an easier trade for the institutions because a buy-side imbalance means what? A buy-side imbalance means sellers below the level. Yeah? A buy-side imbalance means there's got to be a seller below the level. So when I've got a buy-side imbalance here on this little chart, you see the little red square. If I've got a buy-side imbalance from this level, that means there's going to be sellers throwing up their positions if we can get through that level. So when I sell up here, trying to capture this, I've got to be aware, number one, that there was a buy-side imbalance. And we watch. And then when we start seeing these exhaustion prints into the buy-side imbalance, the buyers aren't defending. They're going to throw up and we're going to get a nice break to the downside. So I want to target a buy-side imbalance on these types of trades. That would be perfect for me, wouldn't it? If I could target a buy-side imbalance, it should always be the perfect trade. Well, think about that. Think about that level 2 buy that we were talking about earlier. Do you see what we've got just above it? Look, this level 2 buy trade. So we get the level 2 buy trade, we get the stopping volume, we get the exhaustion print, we've got the volume. But look at what we've got above it. Sell-side imbalances. See the red line? Sell-side imbalances. So we can target those sell-side imbalances, can't we? which means if we can clear those sell side imbalances, we should see an asymmetrical pop to the upside. Well, trying to get into an asymmetrical pop must be a valid opportunity for people to deal. There must be a reason that this market explodes really hard when we get through these key levels. And that reason is that these guys are throwing up their positions. The market maker's going to try and screw them for all they've got. And we end up getting a big asymmetrical response to that trade. Probably too big a response to that trade, but nonetheless a big asymmetrical response and a very, very nice outcome. So in summary, you shouldn't be dismissing your order flow. In fact, quite the opposite. You should be constantly trying to train your order flow, looking for rejections, looking for trapped sellers, looking for the right elements, trying to find the idea of who am I targeting and why am I targeting and what's the value line doing to allow me to take advantage of what happens next. If the value line's in my favor, when I'm getting a level 2 buying at the bottom edge, then that's fantastic. It's just a long accumulation. If the level is against me, it might just be a short covering rally and we might be looking to try and get back into a short trade following the scalp buy. Is the sell side imbalance drawn by OF software? Yes, it is. What did David call it? I don't even know what we called it, buy side imbalance or something. I don't know what we called it. But it's in the OF package, absolutely. And all I've done is I've changed it from 3 to 2 in terms of the multiple, so that we get more examples of prices that we stacked imbalance. Tim, thank you. We get more examples of stacked imbalances. So I've changed the setting from 3 multiple to 2 multiple. And the reason for that is just simply, as I said, we can look at trying to target these types of things in the process. We can look at trying to target these kind of things, okay? So if there's no questions about order flow, we'll take a little break, guys. We'll take a little 2 minutes, and when we come back, we'll talk some curve. 2 minutes. And everybody goes, oh, bloody hell, not the curve. It's time for me to go and get dinner. Stick dinner on, eh? Doesn't develop at all, you make a very small profit and you walk away. Take a look at the euro this morning, and you'll see a lot of arrows. And I want you to get a view of how the arrows would have performed based on the concept of taking out the swing is the target 1, and then a stop at break even. Taking out the swing is a target 1 and a stop at break even. And you've got to keep looking in terms of those arrows at what swing was taken out and what kind of profit you could have made. So I want to show you this. This is how you trade squeezes. Look at these arrows. And tell me if you think you could have made some money on that down move. Tell me if you think you could have made some money on that down move, taking out squeezes, taking out squeezes, taking out squeezes, taking out squeezes. Now remember, every single one of these candles, with the exception of the last one, and that normally happens, of course, every single one without exception, well, sorry, with the exception of the last one, ends up taking out the previous level. So that's 1, 2, 3, 4, 5. But in addition to which, none of these trades actually traded back far enough to get stopped out for the second contract. So you ended up with a runner on 5 occasions. Now, obviously, as I said, when you get into a choppy market, things change. You might say, but that's a loser. No, it's not, because it takes out the previous swing. So you'd have taken your first contract out, and that would have then have taken like a 2-tick, 3-tick profit and a scratch on the remainder of the trade. That's okay. That's what you're looking to try and do with these types of trades. You're wanting to try and get a tiny profit of 1s and 2s and 3s on the first contract, and then if it breaks, then you're in it. If it breaks, then you're in it. On this occasion, it didn't break. It just took out the previous swing high, rejected, and obviously when you see that arrow flipping, you can say, well, that's got to be a level 2 sell. It's got to be. a level 2 short. And of course it is a level 2 short. And you can see that if you add to this picture, a level 2 short is a fade trade, which can lead to a squeeze at the bottom edge, can't it? A fade trade can then lead to a squeeze at the bottom edge. So then we're waiting for the next series of triggers. What are we looking for? We're just waiting for them. There's a sell squeeze, took out the previous swing low. There's a previous swing low back here, by the way. Took out the previous swing low before she goes, so the selling starts all over again. Nice profit on the trade, and ultimately scratch maybe the second contract. Fair enough, doesn't catch a runner. There's a squeeze buy trade starting to work into this swing high now. Starting to work into the swing high. There's a buy trade. There's another buy trade. Doesn't make the swing high. Doesn't make the swing high. So when you get into that buy trade, it does go up by a few ticks and then come back. So you might have been lucky to get a nice scratch trade on it, but you can understand that if it doesn't make the high, that could be the end of the move. And you're obviously going to be looking at selling back against that break to the downside. What happens? What happens? Nothing. Nothing happens. We get another new buy trade. Another new buy trade, another new buy trade, another new buy trade, another new buy trade, another new buy trade. And you can see if you'd followed that process, if you'd stuck with the process, you'd have had to went through some pressure here, but you can obviously see that you could have added back in again here, 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 and here. And you can see that by trading the squeezes, 1, 2, 3, 4, 5, 6, 7 winners in a row, and obviously some really nice runners in amongst those 7 winners, isn't there? Some really nice winners. 8 winners in a row. 8 winners in a row. And then it starts getting a little bit noisy. A little bit noisy now. But we've just had 8 winners in a row. This buy trade actually took out the high. So that's not a losing trade. It's a small profit and a scratch. This sell trade took out the low. So that's not a losing trade. But it's a small profit and a scratch. This buy trade took out the swing high. So that's not a losing trade. It's a small profit and a scratch. This sell got busted, so you would have lost on that trade. Fair enough. You're not going to have 100% winners on anything, are you? Unless it's an arbitrage. You're not going to have 100% winners. This buy trade touched the previous swing low, and but I don't think there was enough room there to get a stop in, so you probably busted on that second trade in a row. So you've just had 2 losers in a row, and most people at this stage would obviously ditch the system, wouldn't they? I've had 2 losers. That system is shite. How am I supposed to make any money if I have 2 losers in a row for 3 or 4 ticks each on 2 lots? That's terrible. So they don't take the sell. The sell breaks the bottom edge, makes some nice money. Get scratched out on the remainder. So you're thinking to yourself, I'm still not making much. 2 buys in a row. Squeeze the top edge. Make some profits. Make some profits. Buy trade, make some profits. More buy trades, making some profits. And look at those buy trades. Look at if you manage to hold on to some of these original swings, and none of these swings have actually got taken out. These bottom edges here have not got taken out. So there could be still some swings in this trade. And look at the profits you would have made on those squeeze trades, guys. Look at the profits. You're never fading a market, are you? Look at it. You're never fading this market. How many people would have thought that that was a top edge coming in? Double tops, triple tops. It's got to be a short trade. And we keep squeezing those sellers now. And they start absolute capitulating, and the price obviously breaks enormously to the upside. Look at all those buy squeezes. How good was that trade, guys? Enormous, wasn't it? Enormous. What a huge profit. Sell trade that doesn't work. A sell trade that does work. Another sell trade that does work. Sell trades that work. Sell trades that work. A sell trade that doesn't work. A new sell trade. A new sell trade. A new sell trade. A new sell trade. Think about what ones you've got as runners here. Think about how you would have been able to trade this with runners. Looking at these directional bets. Looking at when you start seeing squeezes, watching for possible pullbacks, squeezes, watching for possible pullbacks, squeezes, watching for possible pullbacks. You haven't yet seen any condition that suggests that the message has been given to the market makers to flip the switch. And now you see that the market maker is getting conditions to flip the switch just here. Perhaps this is the market maker finally getting told here to flip the switch, which is why we get a buy trade that doesn't work. If I get a buy trade there, what are you probably looking for? If that buy trade doesn't work, you're probably looking for bottom edge buys, because if that arrow tells you that the market makers are getting the nod, and remember what I talked about, top right hand holds after a sell trend, for example, well, obviously how the indicators triggered, it obviously detected that squeeze coming up, which didn't happen, but it gives you a good strong step for a hint that this bottom edge could be tradable, And obviously what happened is that you got a perfect bottom edge and then a squeeze at the top edge that does work, makes some nice money. Now here's a sell, and there's the first pullback to the SR level. And you can see that when that message gets put to the market maker again, it doesn't squeeze the bottom. It gets busted. But that busted gives you a very strong case to start selling the swing. And obviously trying to get in on a fade, and you can start watching the order flow in these kind of areas to try and capture the essence of that sell trade. And you can see the most recent trades have just actually taken out the bottom edge. So those squeeze trades have actually been successful by one tick. And obviously you would have had your stops at break even, and you might have got scratched, you might not have got scratched, but because we're getting squeezes, you should also be aware that you should be looking at these pullbacks as possible short trade opportunities. So whilst this is just highlighting squeezes, you might say, well, why was this pullback not a long opportunity here? Well, you'd have to find the level, of course, and the level would have been this change of behavior here. Well, there was a buy trade here. It bounced off the level, could have got you a profit and a stop at break even, couldn't it? So when you think about it, if I was to talk about squeeze trades and pullback trades, can you see how the squeeze gives you that idea? Because you shouldn't be now facing an uptrending market, should you? Because for these squeeze trades to be working, there must be a trend change. There must be a trend change. You've got to be trading in the direction of the new trend. So if we're trading in the direction of the new trend, for example, we get our first squeeze sell trade here, then obviously that squeeze sell didn't really do very much. But the pullback goes into a level 2 opportunity here. Look at that pullback for a level 2 sell trade. Boom. What about these pullbacks here? Level 2 sell trade, level 2 sell trade. Boom. What about this pullback for a level 2 sell trade? Boom. What about this pullback? Doesn't give us a level 2, but you get the basic idea. What about this pullback for a level 2 sell trade here? Boom. You see how you can use this information about squeezes to get additional trades. It's not about just simply getting the squeeze trade on the books. It's also about trading the pullback based on the information that the squeeze is giving you. And the information that the squeeze is giving you is that the order flow is suggesting that the market maker's being given that information to basically get off the trade. Remember, we've talked about this a few times. Let me just paint it up so that you understand what I'm talking about. Let me paint it up, guys. It's very, very important to read what an indicator is actually showing you, not just look for an arrow. And that's why that's in some ways why we don't like arrows, because you're not reading what's happening. You're actually just seeing an arrow and thinking that's instantly a buy trade or a sell trade, and that's no use. So when we see a market doing something, and we talked about this concept before, when we see a market doing something like this, and then doing something like this, there's this concept that we've talked about regarding the market maker being told by the institutions it's time to get off the trade. Well, if it's time to get off the trade, the first thing that's probably going to appear is a squeeze arrow here, because that's the first sign that you're getting that information. It might be here. It might, however, be here as well. It might be here. It might be here. But think about it. In any of these locations, none of these squeezes, none of the first two squeezes worked. None of the two first squeezes worked, really, did they? Because the first squeeze never managed to make new highs. So you probably, maybe scratched, or in this case, maybe you didn't scratch, but you simply didn't make any money on the first squeeze. You were still waiting. The second trade probably lost money. But because the second trade lost money, but because there's a squeeze there, you would have used this downtick as a buying opportunity to fade the market because you've got the signal that the market maker is being told in terms of the order flow. Now remember, we're not highlighting the phone call. Do you know what I mean? I'm not telling you that the market makers just received a phone call by having that arrow, but what I'm saying is that when you look at the coding behind the arrow, so when I look at the coding behind this arrow here, and we did get the squeeze, for that arrow to exist, the market maker has been passed on the information, and hasn't just been passed on from the information, they've actually acted on the information by letting the price now do what you would expect it to do. So in other words, we're not fading the top edge here because we haven't passed on the information to the market maker to get off the trade yet. This is the market maker getting told to get off the trade. What's most likely to happen? In a lot of cases, it's most likely to go back up and give you the chance now to reaccumulate any last dregs of society that happen to be, inhabiting the top edges here. And you want to start selling into those order flow upticks, because obviously what's happened now is the market maker's been told to get lost. And what should happen now, obviously, is exactly what does happen, is the price then obviously breaks off that little piece of information. And you're not calling it too soon, are you? You're not trying to fade a top edge, and yet you're still selling within a few ticks of the top edge. You're still selling within a few ticks of the top edge. And if you're still able to sell within a few ticks of the top edge, is that not a decent trade, guys? Seriously. Because obviously there's a chance we might get an up arrow to squeeze the top edge, in which case we have to obviously just be careful not to obviously sell it, because we still haven't got a conclusion about what's happening here. But I think when we start seeing these additional arrows here, we know exactly what's happening. The market maker is now gone from below the market, and we can expect to see a continuation sell-off, which is exactly what then happens on the euro until we get down into this bottom edge. And again, we get the message coming from the market makers here. It's not successful, but you then sell the bottom edge. Look, because of that idea of this concept here, because of this idea of the market maker getting the phone call, that's that arrow. That's this arrow here. Now you might be saying, yeah, but the buy trade was away down here. Yeah, but they've still got the phone call. So what all that means is that they haven't got enough business, and there's still enough sellers here. It doesn't mean that the market's not a bullish market. It just means there's enough sellers here to stop the price going on the breakout, because you're not putting big size on this trade. It's just the market maker pulling that causes the break. Because you don't want to put big size at the top edge of the bracket. You want to put big size into the middle to the bottom edge. So obviously when the price comes back down, you're now expecting to see that reaccumulation down here, because we know that the signal is here. We know the signal's here. So unless we get this bottom edge getting squeezed, we're obviously going to be excited about coming back up and retesting that area. And that, in this case, is exactly what happens to that trade. In this case, that's exactly what happens to this trade. The price comes down, we get that reaccumulation down at the bottom edge. Perfect opportunity to get long, and then pop goes the weasel. Pop goes the weasel. Bottom right-hand hold, pull back to the 50 line. Perfect. The first arrow in the reverse is always the hardest arrow. Now, this is interesting because we didn't manage to get the squeeze. So it's going to be interesting to see if we go and squeeze this top edge here. We didn't get the squeeze, so we're going to be watching to see if it goes and squeezes this top edge, and if it does, obviously, then any pullback becomes a possible buy trade on this particular example. Make sense, guys? Should make sense.